Good evening.
Good evening.
So that so then that our host asked us to wait 5 minutes until the attendees are joining with the session. So let's wait another 5 minutes.
Good evening, Ashik.
Hello, good evening. Good evening. How are you?
Good, good. How are you?
I'm good. Thank you very much. Happy to e-connect with all of you.
Yeah.
Hi, good evening, good evening. Sorry, I'm on
Good
my
evening.
way driving. Yeah.
Hi, Ashik. Good evening, Rajit here. Hi,
Hi,
Heshan.
Hi, good evening.
So we are going to start now. Good evening, everyone. We are pleased to welcome you to the SAFA webinar on the post-implementation challenges of IFRS 9 financial instrument. This session is brought to you by the SAFA Accounting Standards Committee. Before we dive in, virtual attendees can submit their questions directly using the Q&A option. We encourage you to participate actively throughout the session. Now I would like to invite the President of SAFA, Mr. Heshana Kuruppu, to welcome the gathering and for the opening remarks. Over to you, Mr. President.
Thank you, Shanta. Good evening, everyone, and thank you very much for joining this virtual session today. I think IFRS 9 is a kind of a complex standard, and obviously there would have been many challenges, and there are challenges still even mature organizations facing. So I believe it's a very timely discussion that Accounting Standard Committee led by Manil bringing today. So I would like to thank the Accounting Standard Committee for initiating this webinar. I'm sure we will be having series of webinars under this committee. And first one is hosted by CA Sri Lanka and presented by Rajit Pereira. So thank you, Rajit, for coming forward to share your knowledge. And we know that Rajit is an expert in this area. Locally, as well as he has done several sessions internationally. So I'm sure the participants will gain a lot of insight through the sessions today. In addition, there are 4 other panelists who are going to share their country perspective representing different SAFA countries, which will also be helpful in us getting more insight and seeing it's not only one country sometimes having the challenge, so sometimes it can be multiple countries going through the same challenge, and even we may find solutions during this discussion today. So with that, I would like to hand over the forum to Shanta back again. And thank you everyone for joining, and looking forward to have this kind of intellectual deliberations because SAFA as a regional body wants to bring this knowledge to our membership. So let's see whether we can connect again, and I'm sure you will be connecting Sustainability Standard Committee also coming up with few sessions. So let's connect again. Thank you very much.
Thank you, President. Let me introduce our presenter today, Mr. Rajit Pereira, partner at Ernst & Young Sri Lanka. Mr. Rajit Pereira is a fellow member of Institute of Chartered Accountants of Sri Lanka and the Chartered Institute of Management Accountants in UK. Mr. Rajit is an experienced financial consultant with a combined experience of accounting and financial services risk management. He leads the largest and the only full-time quantitative financial services risk team in Sri Lanka. Mr. Pereira currently serves as the chairman of the Accounting Standards Interpretation and Implementation Committee at CA Sri Lanka. Now I am inviting Mr. Rajit Pereira to start the session. Over to you, Mr. Pereira.
Thank you, Shanta. Just give me a couple of minutes. I'll quickly share the screen. Shana, could you kindly confirm whether the slides are visible and I'm audible?
Yes, Mr. Rajit, we can see the slides and audible.
Right. Thank you. Thank you, Shanta. Very good evening to everyone who is joining from various parts of the region. And of course, like Mr. Heshana reiterated, it's a quite an important topic, and of course a challenging one with combined complexities with some of the macroeconomic challenges which some of the countries in the region are facing. So that's why we thought we'll bring to you a practical session in terms of discussing some of the key highlights of implementation challenges of IFRS 9. Of course, we use our wealth of experience in terms of implementing and rolling out this standard in multiple countries, including Sri Lanka, Bhutan, Maldives, as well as some other countries in the region. So, of course, I would like to highlight that this session will followed by a Q&A session. There are various seasoned professionals will be joining to answer some of your questions. So unless you have very specific concerns to the areas that I cover, which you can raise it using the Q&A function. If not, you probably be able to direct your questions to your respective panelists who will join the panel discussion towards the latter part of the session. So the highlights of today's session, the next 1.5 to 2 hours, I will probably highlight to you the journey towards IFRS 9. Well, of course, the focus conversation will be in terms of the financial services sector, specifically banks and similar institutions. But however, if you have specific questions regarding non-bank, I'm happy to take it as and when you require clarifications. So we'll talk about some of the key challenges as well as trends that we are seeing in terms of implementing IFRS 9, especially how financial institutions could drive value by harmonizing different verticals of the organization, especially how best finance could be integrated with risk management function to drive efficiencies to derive optimum results. So I'm going to talk about some of these important governance aspects as well, which we feel and we have seen those as challenges, especially post-implementation integration. What does the governance require to, from a finance perspective, as well as credit and risk management perspective, as to how you need to align your business strategy to achieve the desired outcomes? Because one thing that we need to keep in mind is your business will not be driven by the accounting standard. Instead, the accounting standard will start interpreting what you do in the business. So that integration is quite important aspect of the implementation of IFRS 9. So then move on to the discussions relating to model functionalities. What are the key components of expected credit loss model? And then what we need to identify as lessons learned by implementing this standard, because most of the countries, as well as the other part of the world, implemented IFRS 9 with effective from 1st of January 2018. And this conversation happens in 2024. So we have, in hindsight, we have 5 years of experience rolling out these standards, which we can deliberate some of these major problems that we have foreseen in the industry. So then finally, we'll move on to the Q&A session, which will be the last segment of the today's discussion. So if you look at from a financial services standpoint, IFRS 9, from my point of view, is one of the accounting standards in the accounting framework that actually does not talk about accounting. So if you look at any other standards in the accounting framework, it talks about how you need to account for an asset or how you need to account for a liability. But when it comes to IFRS 9, it does talk about how you need to account for, but it mostly talks about your integration of some of these requirements into your business processes. It's more from a banking standpoint. If you look at it, your expected losses will be the biggest challenge. IFRS 9 will talk about how you need to integrate your expected credit losses into your credit risk management policies, your risk management policies, and your underwriting strategies. I'll probably emphasize that towards a little latter part of my session so that you will understand these are more of a practical standard which starts interpreting your business strategy and start interpreting the numbers that are derived out of it. So heavy interlock between different verticals is quite important to reach success in terms of implementation. So this is not a mere responsibility of the financial reporting unit or finance department of an institution. There has to be a heavy integration that needs to come in from credit, especially underwriting. And then there has to be heavy integration that needs to come in from credit risk management unit, which is your second line of defense, and then internal audit, which is the third line of defense. All of these separate lines of defenses will have to be activated and engaged in order to reach proper outcomes. So I'm saying this integration is core, because otherwise what will happen after you implement, few challenges that we saw in Sri Lanka as well as in other countries, after you implement, you will see some of the numbers may not be able to be compared and benchmarked against your actual business practices if your integration has not happened separately, because your credit will interpret underwriting and their risk appetite relating to underwriting in a separate format. And then if finance in isolation start interpreting IFRS 9 expected credit losses in isolation, they will interpret it in separate format. So these will have a huge disconnection, which will create sub-optimization within the organization. So it might have a challenging situation at the time of implementation. So it's important that the development of or the implementation of IFRS 9 models actually looks at how banks look at their ultimate underwriting, how they define risk at the time of onboarding a customer, which is predominantly certain banks use certain tools in terms of achieving that objective. So for example, most of the banks in the region use ratings to evaluate customer risk, and the underwriting policies are aligned to the rating of the customer. So most of the time banks will decide, depending on the rating of the customer, whether to grant the loan to the customer or by what price you need to grant the loan, etc. So the core conversation is how do we interpret that in terms of developing our ECL models? What are the biggest challenges that we foresee at the time of implementation? So the rating models, pricing strategies, all of those will come into the conversation when you are talking about a successful implementation, because otherwise there will be lots of disconnection as well as a lot of challenges that you foresee. The biggest problem that I foresee in terms of implementation is some of these rating models that the banks are using have not been back-tested or validated to assess the discriminatory power. Because the objective of a rating model, if you look at it, by and large, is to discriminate between a good customer and a bad customer. So most of these rating models, what we have seen is the banks used to validate the customer's risk have not been back-tested to see whether the discrimination reached when you rate the customer is actually reflective of the right risk characteristics of the borrower. So then there will be integration challenges, because then you can't rely on some of those models, even though that gives you a better answer. You cannot rely on some of those models to develop your expected credit loss models. So this is a regulatory as well as reporting landscape for some of the financial institutions. You can see there is heavy degree of compliance related requirements for a financial institution. You have requirements to maintain and monitor capital. There are certain models the financial institutions will use for this purpose. Certain banks may be using advanced approaches, certain banks may be using standardized approaches. But if you look at it from a capital adequacy standpoint, if you look at regulatory reporting point of view, if you look at it from a capital adequacy standpoint, credit risk definition could not vary based on how finance define it or risk management define it. Again, it calls for the problem of integration, because if you look at it from an implementation standpoint, for financial reporting purpose, if you develop models in silo, for reporting purpose, you will achieve a separate objective, but for regulatory reporting purpose, you will do completely different calculation and you will achieve a different objective. So some of these areas, especially when it comes to credit risk management, IFRS 9, in terms of expected credit losses, is quite significant and heavy in terms of credit risk management. It purely talks about the credit risk management when it comes to IFRS 9. I'm sorry. Shant, is the slides are not presented?
Ajit, can you just put in the presentation mode?
Right now, I'm on presentation mode.
Yes, that one slide is we can see in the side.
Okay, just a minute. Is it okay now, Shant?
Not yet, Mr. Ajit. Yes, this is right now.
All right, sorry about it. So, so all what I'm trying to look at is at the time of integration or at the point of implementation approach requires to look at how best you can use your existing channels and verticals of and different departments. IFRS 9 will give you a very heavy responsibility in terms of especially in the first year of adoption, because you're required to develop different types of models. Models require calibration and seasoning, where the models require to mature with data. That brings in a heavy workload, especially for finance as well as credit risk management units. Despite of ECL models, then the banks are required to maintain separate models in terms of stress testing specifically for capital adequacy purposes, and then separate models for credit risk management quantification, again for capital adequacy purposes. So now the question is how best your ECL could be integrated by using some of the existing data that you use for stress testing for capital adequacy purposes, as well as using some of the data which you are using for credit risk quantification for capital adequacy purposes. So those are some of the integrations that the bank required to plan post implementation of IFRS 9. So it will not be able to achieve immediately. You may not be able to do it in the first time that you implement, but thereafter, once you implement all your different verticals of your institution, starting from underwriting, starting from evaluation of customers, risk pricing, as well as making provisions and capital computations, all required to align towards the same direction. Otherwise, what will happen, there can be some degree of a disconnect that can be brought in where different types of risks, different departments starts interpreting differently. So that's the importance of integration that we will talk about as we move along. And of course, if you have any questions, please do send us in, or we'll discuss that in terms of our Q&A session. So these are some of the common challenges that we have experienced, just to set the tone for our conversation today. It's very difficult to find the right model when you're implementing IFRS 9 for the first time, because your existing IAS 39 models, which are on the incurred loss basis, will not be able to directly comply with the requirements of IFRS 9. So IFRS 9 expected credit loss models require to be developed specifically for the purpose of assessing 12-month expected loss and lifetime expected loss. I will talk about the functionalities a little later. I'm going to cover the full functionalities in terms of IFRS 9 expected credit losses, but the banks don't currently own that comprehensive and accurate models to calculate the expected losses. Even the banks who have implemented, sometimes you might see certain weaknesses because the models required to be back tested, recalibrated in order to achieve the refined or more accurate predictability in terms of expected credit losses. So the next question is governance. That's the most important as well as the most difficult aspect. Because governance from implementation standpoint, of course, finance will understand this is a requirement because it's stemming from an accounting standard. So most of the time, what we have seen is this becomes finance responsibility. Unfortunately, expected credit loss is not a problem that should be dealt alone by the finance team. Like I mentioned earlier, there are different verticals of the institution that needs to integrate. Your credit risk management team, credit underwriting team, your recovery team, all should integrate your strategy in order to achieve a desired outcome of expected credit loss purposes. Because otherwise what will happen, you will see certain numbers being calculated. I'm not saying the calculation cannot be done. You can do the calculation, but calculation will not integrate into your value chain. Your business operation will reflect certain dynamics which are not being captured in expected credit losses, which is not the objective of the accounting standard. So it becomes a more of academic exercise. So the governance is important, where you assign roles, responsibilities for these different verticals of the organization with the intention of integrating your underwriting and risk management strategy into your expected credit loss computation. And then the third question, the bigger challenge, availability of data. I believe all the panelists who will join our conversations today would agree there will be a challenge, especially at the point of transition, as well as even post-transition. If you look at Sri Lanka, after 5 years of implementation, we do still have a lot of challenge around the spectrum of data. There are instances where sometimes the data governance and discipline is not to the required level of IFRS 9 implementation. So for example, I'll give you a classic example, which is, of course, all regulators in the region require to maintain certain codes to mark and identify the industry, the sector, or the subsector of the borrower. So this identification of the codes, what we have commonly seen, will sometimes not reflect the 100% accurate sector reflection. So for example, in most of the instances, what we have seen, the largest sector becomes other in most of the countries. I have worked with multiple countries in the region, and it's a common weakness that I have seen in all countries. So the subsector or the sector which carries other sometimes is the easiest point of reference, because sometimes that becomes a mandatory data field in your customer ID creation. So most of the instance, what the low-level data entry operators does is, for ease of reference, they may pick or select other sector or the other category as the industry of the borrower. So after 5 years, where you try to model this data into a complex expected credit loss calculation, and when your industry risks do differentiate, of course, the classic example is what we went through pandemic in 2020, 2021, where certain sectors were underperforming while certain sectors were overperforming. So if you recall, sectors such as telecom was overperforming because your working model, operating environment completely shifted. Most of the organizations, at least all of us, started working from home. Your utilization levels changed. Your entire internet and entertainment utilization of some of these sectors started overperforming, while some of the sectors actually did underperform. Like, for example, travels, tourism, aviation, maritime logistics were some of the sectors that were significantly underperforming during the pandemic period. So we saw some banks had challenges in filtering and carving out some of these sub-industry or sub-sector data points to carve out that risk and assess expected credit loss separately. So availability of empirical data will become a crucial challenge. And also at the same time, if some of the markets are quite optimistic in terms of rolling out IFRS 9 systems, you again have a challenge, because most of the banks or most of the institutions do not own data warehouses. So we don't have a data marts or data lakes where we regularly store our data in a logical order, but most of us operate using backups. So when we operate using backups, sometimes system integrations can have challenging environments. So we will speak about some of these as to how it's going to impact and challenge your implementation process, because data availability is something which is quite critical. Even though the data is available, sometimes there is a question that we need to answer: to what extent our data clarity, or to what extent our data is clean enough to use into our computations, to develop statistical models to reflect reasonable algorithms. Because the reason for that is, again, if you mix different characteristics together, of course, your outcome of the calculation or the models will not be quite accurate. So sometimes when there are specific risk factors, you need to isolate those risk factors and assess them for expected credit losses. Then forward-looking parameters, again, is quite a challenging exercise, because, of course, if you look at it from a statistical standpoint, whilst there are quite comprehensive predictive models, you may call it Markov chain, logistic regression, multivariative regression, there can be multiple models that you can use to predict forward-looking outcome. The question that all of us need to answer is how best we can fit that model into a local economy. Because there can be challenges where sometimes certain markets, which is similar to Sri Lanka, your macroeconomic environment might not always define the business performance or the business outlook. So for example, if you look at microfinance lending, or if you look at some of the retail portfolios that you may be running, not necessarily depends on the GDP of the country or the foreign exchange rate of the country. Sometimes there can be certain customer segments that actually really performs well even under the categories of stress, which we saw during pandemic. So if you look at certain specific lending, such as agriculture, sometimes the foreign exchange rate or the GDP might not have a direct impact in terms of the agriculture performance. Alternatively, sometimes maybe the weather pattern of the country might reflect the forward-looking parameters. So again, we come back to challenges when it comes to data, especially when you build certain forward-looking parameters when you try to implement expected credit losses. I think the fifth point I dealt upon, risk to finance reconciliation. That's quite important. What we saw from most of the implementations, credit risk unit does similar activities for various other regulatory purposes. So now the question is how best you can integrate some of those existing parameters that you have into achieving this objective of expected credit losses under IFRS 9. That's one. Even if you don't, or you cannot achieve that objective of integration, if your risk management unit defines a particular type of risk for various other purposes, if finance goes and interprets under expected loss, how do we reconcile these two? Because these two will have to be definitely reconciled, because your credit risk cannot vary depending on how finance interprets it or risk management unit interprets it. So that integration between these different verticals will be important. Then the segmentation, I will not touch the segmentation now, because I intend to do a little bit more deep dive into segmentation towards the latter part of my slides. So these are some of the challenges that you will face when you implement IFRS 9. Even after implementation, some of these challenges will continue to exist. So you will be required to constantly work on some of these areas to improve. So it's a more of a dynamic approach that we're seeing in terms of expected credit losses, which has to be constantly monitored, constantly validated, and constantly calibrated, especially some of these models that you use. You need to work on them constantly in order to achieve a reasonable outcome. So if you look at it from a accounting standards requirement point of view, I will get into the implementation as well as functionalities. The standard works on two different types of loss matrices. One is called the 12-month expected loss, and the other one is called the lifetime expected loss. So the difference between these two is a straight functionality of time. 12-month expected loss captures all probable loss events that will take place in the next 12 months, whilst the lifetime expected loss captures all probable loss events that will take place throughout the entire life of a customer. So when you say life of a customer, it's important that we understand it's not the biological life, it's a relationship period that the standard stresses on. So the lifetime loss category broadly have two segments. One is lifetime under stage 2, and the other one is lifetime under stage 3. The distinction between these two, lifetime under stage 2 refers to underperforming segment of the portfolio, whilst the lifetime under stage 3 refers to non-performing segment of the portfolio. So basically, if you take the entire ECL model into 3-staged approach or 3 different buckets, your stage 1 generally reflects your best set of customers, meaning the customers that you don't see a credit deterioration. Those are the customers that you don't run a risk. Then the stage 2 reflects the customers who are underperforming, stressed, or you might call them watchlisted, which means the customers' risks have increased. They are currently carrying certain characteristics of default, but have not defaulted yet. So the risks have significantly increased. Customer moves into stage 3, then the distinction is the customers will carry objective evidences of incurred losses, meaning all your stage 3 customers are generally treated as defaulted customers. That's the 3-staged approach IFRS 9 requires you to consider. So if you look at the overall provisioning matrix, the 2 dimensions of 12 months and lifetime further fragmented into 2 segments of stage 2 and stage 3, tries to interpret how a customer risks linked to the expected loss provisioning matrix. So for example, let's say if you look at this particular point where the standard always refer IFRS 9 starts with stage 1. So meaning at initial recognition, so initial recognition is the point at which that you underwrite, always your customer will be classified as stage 1. So at the point of underwriting, your customer will be classified always as stage 1. The reason for that is accounting standard takes the presumption at the point of underwriting, customers' credit risk is not significantly increased. And that's the reason why that you decided to give the loan to the customer. Or if you look at it from a investment standpoint, the decision you made to invest because the overall risk of the investment is within your risk appetite level. And that's why the standard says always when you underwrite, you consider that loan as a stage 1. So that's why I said, if I take you back 2 slides earlier, what I spoke to you, your underwriting policy, your risk management policy should integrate with this expected credit loss framework, because your model starts within your risk appetite level. So if your risk identification is flawed, obviously your model will have a knock-on effect on that. So that's why it's important that at the point of underwriting, always your loan is referring to stage 1, meaning standard builds a presumption that at the point of underwriting, your risk is not increased. But there are limited exceptions to this. The limited exceptions that are discussed in the standard agrees on the fact that sometimes you might underwrite to substandard portfolios. That could be your way or the business model, how it works. Sometimes you might take over a non-performing loan portfolio from another financial institution. Or for certain reasons, you might underwrite to a non-performing customer. So those are the limited exception that the standard talks about. So standard classifies that segment under the category of purchase originated credit impaired customers. In short, we call it POCI. So except for POCI customers, all your customers will belong to stage 1 at the point of underwriting. So within stage 1, you will always refer to 12-month expected loss. So meaning from today to the next 12 months, you will identify what are the probable uncertainties that will take place and quantify and estimate the loss provision. So whilst engaging in the credit monitoring process, whilst doing that, you're constantly required to evaluate the credit quality of the borrower. If your credit quality is constantly increasing, or the credit risk is constantly increasing, your credit quality is deteriorating, you're required to shift your customers from stage 1 to stage 2. In other words, after underwriting, you're constantly required to engage in monitoring the customer's risk. Whilst monitoring risk, if you identify that the customer's risks are increasing subsequently, you're required to immediately shift your customers from 12 months to lifetime loss. So instead of looking at 12 months, you're required to look at the lifetime of the borrower, which is again is a relationship period. For example, if you're looking at a 5-year loan, your lifetime losses are all possible losses that can take place from year 1 to year 5. Will allow you to take a holistic picture of the customer's risk assessment. So when this particular jump takes place from 12 months to lifetime, one thing that we need to bear in mind is your provisions will also exponentially increase. The reason for that is your loss emergence period immediately changed from 12 months to lifetime. So for example, if you're looking at a 5-year loan, now it's not 12 months you're looking at 60 months. So the 60 months will result in multiple uncertainties as opposed to compare to next 12 months. Because of the relative shorter period in the 12 months, your probable uncertainties that can take place could be limited. But if you compare 60 months, the number of risks that you will face, if you take, for example, what happened in the last 5 years, all economies went through quite a challenging period where we went into negative GDP growth, where almost economies stalled because of the pandemic. And then you look at, there are lots of uncertainties that we had to look at. So 5-year period, for example, is a greater period. It's a longer period. So your uncertainties will be multiple, leading to recognition of very high expected credit loss provisions. So generally the jump from stage 1 to stage 2 is quite high. Then from stage 2 to stage 3 happens when the customer defaults and the objective evidence of incurred losses. So once you identify objective evidence of incurred losses, you're required to identify your customer as stage 3. So stage 3 customer is identified as a customer who is already defaulted, which is similar to incurred loss concept. So if you look at similarities between IAS 39 modeling is very much similar to your stage 3 characteristics, because we will be relying on incurred loss model. So these are some of the core principles of expected credit loss determination. So if you look at it, there are 2 broader concepts, 12-month expected loss versus the lifetime loss. And lifetime loss gets subclassified into 2 separate categories of stage 2 and stage 3. Stage 2 refers to underperforming and stage 3 refers to non-performing. So here, next question that you might have, or probably to want to clarify, is, okay, how do we allocate our customers into stage 1, stage 2, and stage 3? The standard looks at it from a risk monitoring standpoint. Well, the standard doesn't give you a direct answer to it in the body of the accounting standard. It is looked at it from a risk monitoring standpoint. What the standard says is the manner in which you monitor the credit risk of the borrower shall be integrated to the staging process. So when you look at how a bank monitors the risk of the borrower, well, most of the banks, like I said, uses a credit rating approach. Banks do have an internal rating where they consider for underwriting purposes. So one of the tools that the banks use to assess the customer risk is the internal rating that they assign. So depending on the type of the portfolio, whether you're looking at a corporate portfolio or a retail portfolio, the frequency of rating might vary. So now the first question that you have is to answer at the time of implementation, can I use my existing internal ratings that I use for underwriting for the assessment of expected credit losses to integrate with IFRS 9? So answer for that is yes, but there are certain prerequisite conditions that you require to satisfy. You can use the ratings to do this discrimination between stage 1, 2, and 3, as long as your ratings have been adequately back-tested and validated, where the rating drives reasonable discrimination between a good customer and a bad customer. So again, to share my experience, the bigger challenge that we have seen is most of the banks do have rating systems, but sometimes not all the banks have validated these rating systems. So for example, the objective of a rating system is to study 15 or 13 variables. Some banks do have more, some banks do have less. And then based on the assertion of these variables to assign a score to the borrower, and that score links to the rating. So for example, let's say if your borrower is age between 20 to 30, 30 to 40, 40 to 50, obviously you will assign different scores. And then if the borrower's income capacity is 0 to 100,000, 100,000 to 300,000, 300,000 to 500,000, you assign certain scoring with the objective of, depending on certain risk parameters, how you rate the borrower. So generally the presumption is if you're earning more, you will get more marks. If you're earning less, borrower's earnings are less, you will probably get a lesser mark. So if it's a corporate customer, you will evaluate the financial stability. You will look at key ratios, debt to equity, gearing, etc. So now the question is, each of these questions that you tick, which leads to a score and which lead to a rating, does it adequately discriminate the borrowers? I'll give you a classic example why we are sometimes saying your objective may not be achieved. So for example, let's say you take a retail customer, a simplest example. The retail customer generally higher the earnings, better the rating. Because if, for example, let's say if the earnings are more than 500,000, sometimes you might rate them better compared to a customer who's earning 200,000. But if you really look at a logical standpoint, we have seen when we really validate these rating models, sometimes that parameter alone doesn't reflect you the right risk characteristics. We have seen the person who's having 500,000 income can have 5 dependents who are dependent on him. So disposable income per dependent would be 500,000 divided by 5 members, per member it's 100,000. But sometimes the person who is earning 200,000 may have only 1 dependent. So the disposable income per dependent could be much greater than disposable income per dependent of the person who's earning 500,000. So that's a quick example just to tell you. Sometimes certain variables in isolation may not allow you to achieve the desired outcome. So you need to statistically validate these models using certain statistical quantifications such as Gini coefficiency or PS-stat to understand whether these ratings that you have had in the past 5 years, whether it's properly discriminates the borrowers. If it does, you can surely integrate your internal rating model into the determination of expected credit losses. If it does not, if your Gini validation results are less, you probably may not be able to use the ratings at the starting point. So then the question is, if you cannot use the ratings, what else can you use to identify these stages of stage 1, 2, and 3? So then we boil down to the basis of conclusion of the standard, where standard very clearly defines 2 backstops. In the event that you don't have any other discriminatory method to identify stage 1, 2, and 3, standard introduces 2 rebuttable presumptions as 2 backstops, where it says above 90 days past due, it reflects objective evidence of incurred losses. So basically, you identify this staging based on the number of days past due. If your customers are above 90 days past due, those customers will belong to stage 3. And if your customers are more than 30 days past due, meaning it's 31 days to 90 days, will belong to stage 2. And your customers less than 30 days past due will belong to stage 1. So these are the 2 backstops introduced by the standard: 30 days past due and 90 days past due. So those who are unable to integrate your credit risk strategy as to how you underwrite into ECL using ratings, then probably you don't have any other resort except for relying on the 2 backstops in the standard, 30 days and the 90 days. Also, if you read the basis of conclusions very carefully in the standard, it says these 2 backstops are lagging indicators, meaning the fact that your borrower is already 30 days past due is not expected loss. The fact that borrower is already 90 days past due is not expected loss. Those are characteristics of incurred loss. So the basis of conclusion is very strong to say, when you don't have any other alternative, yes, you can use 30 days and 90 days, but then your management overlays will have to be quite significant, where you remove some of these lagging indicators by using qualitative and other quantitative parameters. So the question there that you need to answer is, those who currently use staging based on delinquency basis, if you only stage according to the 2 backstops of 30 days and 90 days, you're not fully compliant with the requirements of the standard, because then you're required to incorporate various other parameters into the staging process. What are those various other parameters? You need to look at what are those additional risks that you have identified, which are not reflective of your number of days past due. If you look at 2 years back, almost all countries offered moratoriums to certain industries, certain sectors, certain clients. And to my knowledge, certain banks, certain countries do offer moratoriums still to identified sectors. So meaning you're constantly providing them with financial support, which will not get reflected with days past due. Because the moment you offer the moratorium, most of the time, your days past due will get frozen. So then the question is, if you're using a DPD model to reflect staging, whether it reflects the right risk characteristics. The answer to that is no. So then you need to use other qualitative information, such as information that currently referred by your risk management unit or credit underwriting unit for underwriting purposes. So for example, let's say your credit risk management unit might identify certain elevated risk industries. If you have identified aviation or maritime as elevated risk industries, you probably might want to shift staging of those sectors despite of their days past due. So for example, let's say there may be certain customers in maritime industry. Currently, it's not gone beyond 30 days in arrears, but you foresee due to a industry or economic impact that sector will underperform in next 3 to 6 months. Today, you're required to shift the stage, probably from stage 1 to stage 2, or if the customer is already in stage 2, maybe to shift it from stage 2 to stage 3. And then calculate the respective provision accordingly. So that's where the other qualitative indicators should come and support, despite of using the days past due, where the days past due were already lagging indicators. You try to overcome that weakness by parameterizing whatever the information which is available to you by looking at some other risk factors. So then you might ask a question, okay, do I need to shift the entire industry? So if I have, let's say, 1,000 customers in maritime industry, do I need to shift the entire 1,000 customers? So that's an assertion that the individual institutions will have to perform. If you believe that entire customer base is not impacted by the macroeconomic downturn, then probably you can identify those customers who are impacted and then shift them only. But if you believe that the entire segment gets impacted, it's a common phenomena to the entire industry or entire sector, then you probably will have to shift your entire customer segment to those industries. Entire customer segment to stage 2 or stage 3 category. So all of that decision will have to be taken from a finance standpoint as well as integration with risk management, because sometimes your finance and reporting teams will not have that information. Identification of elevated risk industries or stress sectors will be done sometimes centrally by credit or credit risk management unit. So that information will have to be flown on time for the staging to be taken appropriately. Then the next area that we need to focus is in terms of income recognition. Your income is required to be recognized on gross carrying value for stage 1 and stage 2, because between stage 1 and stage 2, there's no incurred loss. It's predominantly expected loss. But when you move into stage 3, your interest income will have to be calculated in terms of net carrying value basis. The difference of logic that the standard stipulates there is a distinction between stage 1 and 2 losses versus stage 3 losses. Stage 1 and 2 losses are probable losses that will take place at a future date. But stage 3 losses are already taken place today. So the argument that standard builds in terms of income recognition, in line with SLFRS 15, the standard very clearly defines that your income should not be recognized for any amount which is uncertain to be recoverable. So meaning, under any circumstance, we should not recognize income on an amount which is uncertain to recovery. So stage 3 is an incurred loss basis. So we conclude that loss has already taken place, and we have made a provision for irrecoverable component based on our past experience. So for example, let's say I have a 100 rupee loan. I have already made a provision of 30. And let's assume the interest rate is 10%. So on 100 rupees, I have made a provision of 30 on incurred loss basis. I take the presumption I can only recover 70 rupees. So when you recognize income, if you recognize on full 100 rupees, you're recognizing an element which is probably recoverable. Therefore, the standard restricts that you cannot recognize on gross carrying value. Instead, you have to recognize on the net carrying value. So you have to recognize interest not on 100, but on 70 rupees. So 70 rupees into 10%, if your effective rate is 10%, you will have to recognize 7 rupees as interest income, not 10 rupees. So that's a key challenge at the point of implementation, because most of your interest income is geared through the core banking systems, and the core banking systems will reflect the legal interest income recognition as well as regulatory requirements in terms of your respective central banks. So most of the central banks in the region requires you to suspend the interest post 90 days. So the core banking is also geared post 90 days. You will not recognize interest into income. You will accrue it, but into a suspense account separately. So then you will have to work on a manual adjustment to carve out the amount which is irrecoverable, and then recalculate your interest on the net carrying value. And probably as a reporting adjustment, you're required to pass that entry at each reporting date. So there will be some challenge in terms of income recognition as well that we foresee at the time of implementation. Well, there are certain things that probably you can take practical way outs in terms of implementation. Well, of course, it depends on how your regulatory principles are being interpreted. Now, for example, in Sri Lanka back in 2018, our central bank regulation was also similar, where the central bank required to suspend the interest in line with their prudential regulation. If you look at the accounting standard also emphasized the fact that your standard will require to be implemented in line with the local risk management practices. So the local risk management practices will reflect predominantly your regulatory pronouncements. So to a certain extent, the accounting standard accepts the fact that if your local risk management practice, it interprets in a certain manner, you can embrace that within the accounting standard itself. So if you look at in year 2018, when Sri Lanka first implemented IFRS 9, most of the banks continued to suspend this interest because of the fact that it's a regulatory risk management requirement, and the accounting standard allows you to look at internal risk management practices in line with the regulatory pronouncement. But now we are in a unique position after 2021, where Central Bank of Sri Lanka revoked prudential regulation in terms of loan loss provisioning and admitted and accepted expected credit losses in line with IFRS 9. So if you look at the banks in Sri Lanka today, we don't have dual reporting. We have expected credit losses, which is in line with IFRS 9. Of course, the regulator has issued 2 directives to clarify certain areas in terms of consistency. And in that directive, specifically, regulator has revoked all previous directions in relation to prudential reporting, which includes the directive which requires you to suspend the interest. So now in terms of the risk management practice in Sri Lanka at the moment, we don't have an option to suspend the interest because the regulator has revoked, and regulator is very clear that you're required to recognize income on net carrying value basis. So now all banks in Sri Lanka require to perform this interest adjustment for stage 3 customers. So that's going to be quite a challenging one, because in a classroom example, they can be quite straightforward, like I explained to you. However, it can have inherent weaknesses, which is customers, of course, after 90 days, settles partial installments, settle only interest sometimes. So actually, actual settlement reconciliation could be quite challenging because we need to keep in mind, according to IFRS 9, you will recognize some portion of income. And your systems are geared to recognize income on cash basis. So now then you need to have a reconciliation between what is accrued and when the customer settles, how much had been already recognized, and the balance will have to be passed on as a separate journal entry, because otherwise there can be a duplication of income recognition that can also take place, which is quite a challenging exercise when it comes to recognizing interest income. Right, so those are some of the common functionalities of the system. So far, we do not have any questions, so I'll move on to the next area. So which is in terms of parameterization and validation of the expected credit losses. I think these 4 are some of the important consideration that a preparer needs to consider when developing expected credit loss models. Portfolio decomposition is important. That is how different risks have been identified within the portfolio, different products, different segments. That stratification of the portfolio plays a pivotal role when you develop expected credit loss models, because like I said earlier, it's very difficult that you can put all your different risk profiles of borrowers and products together and assess for expected credit losses. Instead, you need to identify or stratify the portfolio at a granular level which reflect homogeneous risk characteristics. So now the question is, when you identify these homogeneous risk characteristics, there's no rule of thumb. The standard does not define how do you need to identify homogeneous risk characteristics. Again, it boils down to the fact that how banks looks at risk. So again, there are 2 methods of how bank looks at risk. One is the bank can look at risk based on the type of customer, where the risk is centric to the customer, not to a product or a facility. That is one and the proper way of looking at it, one school of thought. But of course, if you're going down the route of segmenting the portfolio based on the type of customer, whether the customer is corporate, whether the customer is SME, retail, microfinance, etc., then probably you need to look at a different way of segmentation, ideal way, which reflects the customer risk. Again, we boils down to customer rating. So if you don't have customer rating, you need to deviate from the customer risk, whether you like it or not, because only way that you can capture the customer risk holistically is by looking at the customer's rating. So like I mentioned earlier in my previous slide, if you don't have that infrastructure where the rating models are frequently validated and the models carry the required discrimination, unless you have that infrastructure, you probably will have to deviate, whether you like it or not, from a customer-centric risk to a more product-centric risk, because then the next type of closest to reality is the different type of product. So when you look at the product-centric risk, of course, depending on the type of the product, whether it's a housing loan, overdraft, credit card, personal loan, you will have different risk characteristics that are attached to it. So then you need to deaggregate the portfolio to those individual risk levels. So within those products, if you ask me the question, can I stop at the product? Because I see most of the banks calculate their ACLs at the product level. Again, answer to that is no. Within the same product, you can have further different risk characteristics. So for example, if you take leases, you can have differential risk characteristics depending on the type of asset that you lease, whether it's a motor car, whether it's a three-wheeler, two-wheeler, machinery, equipment, etc. If it's credit cards you're looking at, you can have a differential risk characteristic depending on the type of card, whether it's a entry-level card or whether it's a more premier customer category type of a credit card. So all what I'm trying to get at is there is no one rule of thumb that you can use when you're trying to segment or stratify your portfolio. So once you define your stratification, which is ideal in terms of the risk management, then you need to look at the maturity profiles of your different products, because your different facilities within the same segment can have different life cycles. So for example, a housing or a property mortgage loan can have 5 years, maybe up to 15 years. Again, you can have a challenge. You cannot put the 15 years together with the 5 years. Because if you look at lifetime loss, the lifetime loss emergence period of a 5-year loan versus the lifetime loss emergence period of a 15-year loan is completely different. So upon stratifying the portfolio into risk, and then you need to stratify it to different maturity profiles. Well, I will talk about a little bit more in detail when I talk how to calculate the probability of default and the outcome of the probability of default. So the maturity profile also plays a pivotal role. So for example, if you look at products such as overdraft, mainly it's a 1-year renewable product. So then all the overdraft facilities that are within 1 year mostly can be clubbed together. So then you can assess for probability of default assertion together. But that maturity profile assessment is quite important. The next question is on the vintage. How long have these loans been in my books? There are certain loans that have been with the bank for more than 5 years, more than 2 years, more than 1 year. So depending on that vintage period, the loss experience that you have exposed to can be different. If I may put it from a more simpler point of view, all what I'm trying to look at is, if you take a 5-year facility, depending on where you capture this facility for modeling purposes, the behavior pattern could be slightly different. So for example, let's say when you take your facilities of a leasing product for the calculation of probability of default, the loans or the facilities that you are granted in the same year itself. So let's say if you're doing it for 2024, you capture the loans that you've granted within 2024. So the loans that you have granted within 2024 itself has a lesser probability to default in the first 12 months. Why? Because you have just done that credit underwriting. So probably each bank has its own underwriting policy. You look at risk, you assess the customer's risk from various aspects. So there is a lesser chance for the loan to go into a default immediately post underwriting, unless there is a significant environment issue like we saw during pandemic. There were loans that went into immediate default right after underwriting due to pandemic and external uncertainty. Other than that, the first 12 months, generally, there is a lesser probability. Then the probability increases gradually as you transition towards the middle tenor of the loan. So the second, third years, your probabilities can gradually increase because it had been longer since you underwritten the facility and you have evaluated the customer's risk, and customer parameters may have changed in sequence to your external volatilities. So then the midpoint of the lifetime of the customer, you generally see very high default probabilities. Again, towards the tail end, it tapers down. The reason for that is since you have paid majority of the loan, you have a compulsion that you have to settle the facility. So then the default tapers down gradually towards the tail end of the facility. So now you can see, depending on where this data set of your portfolio, it has a direct implication in terms of capturing your probabilities of default. So when you take your last 5 years of data to calculate probabilities of default, you have a blend of all of these loans. So depending on how this blend results in the behavior, your PDs will be impacted. So that's why the vintage is important to understand how long these loans have been in the books. So generally, we consider as a rule of thumb, if at least the loans have not been there for the last 3 to 6 months, generally your PDs are not refined, your PDs are not reflecting the right picture. So that vintage assertion is important. So we do a PSI test before we model the data to understand whether the data population is adequate and reflective of the right characteristics that you require to look at. Because if the PSI test fails, meaning your data is vulnerable. When your data is vulnerable, you can see spikes in the probabilities of default as the data set matures. So that's why the vintage assessment is going to be important when you develop your expected losses. And then finally, your environment that you operate, which is the core, which of course will have to be factored through multiple parameters. I think we discussed a little earlier how risk can input the identification of elevated risk industries into this assessment, combined with your economic factor adjustments that you're going to look at, how your macroeconomic environment behaves, how you have developed your probability weighted multiple economic scenarios. Everything boils down in terms of determining the environment which will drive the expected credit loss. I think these are the 4 important aspects when you aspects that you'll have to think before you start modeling for expected credit losses. Well, of course, these are the functionalities of the model. These are the components of the model. Instead, you need to have these segments or these functions in all your expected credit loss models. You need to have your probabilities of default. I think in my experience, the probability of default is the most challenging calculation, because you're required to develop probabilities of default for different segments, different maturity profiles, where you're required to establish a PD term structure. I will go into detail into each of these functions that you'll have a relatively a clear idea. It's very difficult to do it within us, but I'll try to cover the core areas that you need to keep in mind so that at the time of implementation and post-implementation periods that can come to support you. So then the probability of default should get combined with the exposure at default. So the exposure at default is the outstanding amount of the facilities. Well, the outstanding amount of the facility is not the today's outstanding amount. You need to anticipate the future outstanding amount at the date of default. Because the problem that we face is we are trying to frame expected losses. So expected losses is not only the losses that have taken place today. It also includes the losses that have taken place at a future date. So if you go back to my, recall my first slide, where you had 3 buckets. The stage 3 is the incurred loss. I think that's the easiest to deal with when it comes to exposure at default. Because if it's incurred loss, what you will lose is today's outstanding. But if it is expected loss, you're not going to lose what is outstanding today, but you will lose what is outstanding as at a future date. So you need to model the amount of facility that will be outstanding as at a future date. So when you say future date, depending whether it's 12-month loss or lifetime loss, you have to decide, are you looking at the next 12 months or the next 60 months? Again, you have another complexity. I will go into detail whether it's a term product or revolving product. It can have an implication because the behavior is completely different. In a term product of such as, let's say, term loans, you underwrite today and you're expected to repay over a period of time. Versus you take a limit-based product such as OD or trade finance or credit cards. You're not underwriting today, but you're assigning a limit today, which is approved where the borrower can use within that limit at their discretion over the next 12 months or 24 months. So then how you need to deal with how to model for this can be different in each of those instances. Then comes the loss given default function, which is tries to capture how much of a loss you're exposed to at the point of default. And then your EFA and the discounting factor will come into the picture. So these are the key components that you need to focus. We'll go into detail one by one and I'll take a deep dive. I hope that I'll be able to manage within the time allocation. So there are two questions that I will take. So there's rather one question. In government organizations, employees are given staff loans at a lesser rate. In such situation, how it measures at effective interest rate and the accounting entries applicable? Well, the question is not directly relates to impairment, but in very simplest format, you're required to measure all your loans initially at fair value. So for example, let's say in an organization where the market rate is 10%, but you're giving a loan at 4%. 4% does not reflect the fair value. So you're required to recalculate the fair value for initial measurement purposes. So when you recalculate the fair value, assuming the loan is 100 rupees, if your market interest rate is 10%, you will discount your future cash flows at 4% using 10% interest rate. So your present value will be less than 100. So your present value will be, for example, 90. So then the 10 rupee, the initial difference that you get in day one, you're not charging that to P&L because this is a staff related loan where you're able to get the staff member to work within the organization, as a result of which you will be able to generate value to the business. So therefore, you're permitted to capitalize that 10 in the balance sheet as a prepaid staff expense, meaning it's a cost to you, but you're capitalizing it because with the assumption that staff member will stick within the organization during the tenure of the loan. So then the fair value for initial recognition purposes of this loan is 90, not 100 rupees. And the balance 10 you have capitalized in your balance sheet as a prepaid staff expense. If you look at the double entry, you'll credit your cash 100, debit your staff loan 90 rupees, and prepaid staff expense debit in the balance sheet 10. Then what happens? You recognize interest income at the effective interest rate, which is 10%, the market interest rate. So your SPPI test will not be failed because you have fair valued the loan at the outset and your fair value is 90. You recognize your interest income at 10%, which will credit to P&L, and you debit your part goes to your staff prepaid expense account because you have to amortize the expense account back into P&L. So when you amortize, the difference between the debit and the credit will be your legal interest differential. So that's the accounting treatment that you require. So after day one, there will be two separate entries. You will create the interest at 10%. So your 90 will gradually build back to 100. Assuming there's one bullet payment for simplicity purpose. So you will debit the loan receivable account and credit your interest income, right? And then on the other side, you will amortize your 10, which is prepaid staff expense. You credit your prepaid staff expense account, debit your P&L. So your debit and credit will offset. If both you are just using effective interest rate, there won't be an implication. So then whatever the interest the staff member required to pay, you can recognize it over and above as income. So your P&L becomes neutral. Your balance sheet will reflect the right value. So that will be the entry that you require to consider. Right. So getting back to the discussion in terms of the functionalities, The probability of default, if you take, we'll go into the discussion in terms of the PD calculation first. The probability of default calculation, in terms of the data availability, we don't foresee a major challenge because the primary data requirement is your number of days past due of the facility at each reporting date. Ideally, you can model this data on a monthly basis to the last 60 months or quarterly basis to the last 60 months. So you need to have that many data points in your institution. So in terms of the PD, we don't see a bigger challenge in terms of core data which is required. Only challenge that we see is depending on the stratification, your data should support your stratification. So for example, if you're going to identify leases into the different type of assets, your customer facility level data should support the identification of different type of facility. So the challenge here would be the amount of work that is involved, because you're required to monitor the last 5 years, which is minimum requirement for historical data for probability of default modeling, minimum last 5 years of data, and identify the pattern at which those customers have gone into default, which is your past experience. So there are different methods that you can use. We generally use models which are based on transitional matrices, meaning we compare the movement from one delinquency bucket to another using Excel, putting a pivot table, comparing how the DPD moved from 1 year to the other, and then construct a PD term structure. So this is the outcome that you see of performing the probability of default calculation. So essentially what these rates indicate is during these defined periods of time, these are the proportionate of loans that have gone into default. So if you look at current facilities, within 1 year, there is a 0.02% chance to go into default, whilst 1 to 30 days customers who are 1 day, between 1 to 30 days past due have 1.03% chance of a default, and 31 to 60 days customer have 7.04 chance of a default, while 61 to 90 days have 11.3% chance of a default. So you can see, as you go down the delinquency state, your probabilities of defaults are increasing. So that's one important characteristic, because your quality deteriorates when the customer aging drops. More closer to 90 days, you have a higher propensity of default. So that's the logic. So as it deteriorates, when you go down the aging, your probabilities of default also should show or reflect an increasing trend. Also, at the same time, when you increase the tenor from 1 to 3 to 5 to up to 10 years or maybe 20 years, also your probability of default should reflect an increasing trend, because there is a larger loss emergence period, meaning higher the amount of events that can take place which can drive a customer into a default. So there can be cumulatively, these are all cumulative numbers I'm talking about, cumulatively you can have a higher probability of default. So these are some of the important aspects that you require to look at. So when you calculate the PD, that's a pattern in which that customer goes into a default. So from current, your customers don't go into default overnight. First, they will have to go into 1 to 30, 31 to 60, 61 to 90. Likewise, they are going to each delinquency pattern. So at each month, you monitor the behavior of customers from each of these delinquency buckets, and how many of your current customers have moved to 1 to 30, or rather how many of 1 to 30 have moved to 31 to 60. Likewise, you analyze the pattern of from your current bucket, how many of them have gone into 90 days over a period of time. So in simple terms, it's from each delinquency bucket, how many shifted above 90 days, but it's not only that, but it's combined with the period of time. How many went within 1 year? How many customers went within 2 years? How many customers went within 3 years? So that's the analogy that you require to assert when it comes to probabilities of default. The challenge in IFRS 9 modeling compared to LKS 39 modeling is that the model required to model required to factor the time of the loss emergence. Meaning, since you're talking about lifetime losses, I think I spoke about this briefly earlier. Under the maturity profile of facilities, you can have 5-year loans, you can have 10-year loans, as well as you can have 3-year loans. So lifetime loss for a 5-year loan will be different than of a 3-year loan. So then you need to have this PD term structure, which tells you the probability of default not by the delinquency bucket, but by also the loss emergence period. So the next important consideration is more of a practical point of view. You might ask the question, okay, if you want to get, let's say, 20-year PD term structure or 10-year PD term structure, does it mean that do I have to have last 10 years of historical data? Answer to that is no. You probably can rely on the minimum data set of 5 years and then statistically extrapolate using a 5-year algorithm up to any number of years. So that's what we generally do for any loans which are beyond 5 years. So Sri Lanka, of course, through the Directive 13, which is issued by Central Bank, as well as if you look at globally, the best practices of implementation of Basel requires minimum of 5 years of data if you're looking at any type of credit risk model. So your starting point is 5 years. Sometimes in your respective jurisdictions, that might come through as a regulatory requirement, or that can come through as a global best practice. So we generally model it within 5 years, and then thereafter we extrapolate using Excel, using scatter diagrams and lines of best fit. So these are very simple, straightforward extrapolations we do. We plot the 5-year relationship, and using a log normal or exponential relationship, we extrapolate it to any number of years, even up to 50 years you can extrapolate using the first 5-year cyclical relationship. So that's important consideration. Those are some of the important things that you need to keep in mind. Well, the lifetime loss is applicable only for these two buckets, which are highlighted in red, 31 to 60 and 61 to 90, because we discussed the two backstops. As a result of that, less than 30 belongs to stage 1, which is only 12 months. So if it is stage 1, you only require to look at the next 12 months. You're not required to look at your entire lifetime. So these two buckets, your assessment of PD can stop at here. It's only for illustration purpose that we have given the PD term structure up to 10 years, but actually only requirement is for current and 1 to 30 days to look at 1 year probability of default, because it's only 12-month expected loss you're looking at. But 31 to 60, 61 to 90, you're required to look at the maturity profile, or the maturity profile of the facility, whether it's average 3 years, 5 years, 10 years, or 15 years, depending on the type of product. Again, above 90 will be straightforward because it's 100%. You can see it's right throughout, 100% for any number of years, because presumption above 90 is customers have already defaulted. PD is equivalent to 100%. So you don't model above 90 days. That's a rule that you use. You consider direct 100% for calculation purposes. Right, so this is the hypothesis as to how the model has been applied. Just to share with you very briefly. So when it comes to the calculation of expected loss model, then there is a question, okay, how do we model this lifetime loss? Okay, I have set of probabilities of default. I have, depending on the type of product or the aging of the borrower, I have these different PDs that I have calculated. Okay, what's the logic in which that you're going to apply the is of default into the ECL computation? The logic is on the method of survival. So that is basically, let's say you have a loan which is given for 5 years. You have a facility. If you ask me the question from a human standpoint, I will not be able to tell you at which point in the next 5 years this customer is going to default you. I think that is not an expected outcome of expected loss. Instead, what we do is we use a hypothesis where based on past data, we have calculated, okay, we have a probability of default of first year of, let's say, 7%, probability of default of second year also, let's say, 7%. So likewise, we have a probability of default. How we apply this into the number, if your probability of default is 7%, right? Meaning in the first year, if you have 100 customers, 7 customers will default. But if you ask me who are those 7 customers, I don't know. It's a portfolio behavior, right? Out of 100 customers, 7 customers will default you. And if the 7 customers default me, 93 customers will survive. Because my assumption is they will not default me in the first year. So if you ask me, how do I get this 7? Based on my past 5 years of data. Now, my past 5 years of data has nothing to do with expected loss. It's my incurred past pattern, right? So my conversion to expected loss comes as a separate calculation adjustment, right? So out of my 100 customers, 7 customers have defaulted me, meaning 93 customers will survive. So for the second year, in a static balance sheet, my 93 customers, out of these 93 customers, some customers can go into default in my second year. Some customers can go into default in my second year. So let's assuming simplicity purpose, my second year probability of default is also 7%. From this 93, 7% of these 93, approximately 6 customers will default me in the second year. Right? So altogether from 100, 13 customers have defaulted. So 7 customers have defaulted in the first year, 6 customers have defaulted in the second year. So to the third year, the balance 87 customers will shift. So anybody who's going to default me in the third year is out of the lot of 87 customers. You can see that we're building a hypothesis based on the past pattern of default data and create a scenario where we would assume based on the past stats, first year, there is a 7 customers can default me, meaning 93 will survive and move to the second year. And from that 93, 6 customers will default, again based on the past pattern. So that's how you will establish your lifetime loss assertion. So same exercise, you will do it for the remaining tenor of the loan. So if it's a 5-year loan, if you're looking at lifetime losses, you will do the same exercise. How many probability of default is there in the first year? If it survives, how much will move to the second, and how much of a default probability is there in the second year? If it survives, how much will move on to the third year? Up to the 5th year, you will perform this survival analysis and apply the respective default rates, which will help you to look at your lifetime expected credit losses. Right. So there's a question which is relating to segmentation. So the question broadly considers the fact that the leisure sector in Sri Lanka, which took a beating due to political mismanagement of a lot of hotels and other guest houses, defaulted on the loans taken. However, they have more than 90% have recovered and settled the arrears and have come to an arrangement within the respective banks and financial institution. How does this equation works? Right. So the first question, like I said, I think I covered to a certain extent in my explanation. The management will have to take a call from the sample of hotels, whether you're looking at a common problem that is prevalent to everybody, or it is a specific problem that you're looking at identified hotels. So in staging, that's the first determination. Is it a common problem that you foresee, or it's only a problem to few? If it is only a problem to few, you can identify the customers who are with the problem, then you move those specific customers from stage 1 to stage 2, right? If you cannot identify, then we have an approach called top-down approach. So the top-down approach meaning I cannot identify, I know there is a problem, but I don't know exactly which whom is the problem. Because when you manage a larger portfolio in collective impairment, individual impairment, of course, not a problem, but in collective impairment, when you manage a larger portfolio, it's very difficult to go to that granular data point and shift that. If that's the case, you need to take a management judgment to what portfolio fraction you experience this problem with. So basically, if you don't know where it is coming from, you have to say, okay, whether it's a 10% of your population or 20%. So it can link to some degree of significant judgment exercised by the management. So then 10% of that portfolio you probably shift from stage 1 to stage 2. Again, you don't know which customer, you shift 10%. That approach is called top-down approach, which is allowed in the standard. The bottoms-up approach is where you go to the respective facility and you shift the facility. So, well, the question relates to arrangements that the customers have made with the respective banks. Probably, I think you're referring to a restructure or a reschedule. And then how does it work in such instances? So probably depending on the support the customer needs, banks can negotiate their terms of the facility, restructure them or reschedule them. If the restructure or reschedule takes place when the customer is NPL, right? If the customer is NPL, then it goes back to the normal recognition principle of the loan. You have to look at whether the restructure or reschedule is a significant restructure or a reschedule. If it is a significant restructure or a reschedule, sometimes you will have to de-recognize the loan and recognize the new facility at the effective interest rate. And when you do that, since you're granting a facility to already a non-performing customer, you're required to push the loan in day 1 into stage 3, which is called the purchase originated credit impaired, POCI. And then in line with internal risk management practices, you're required to monitor this facility. So for example, let's say customer strongly adheres to restructured terms and continuously repay, then you can monitor the customer for a predetermined period of time in line with the internal risk management policies. So after the customer successfully completes the minimum monitoring period where he clears all his arrears, after clearing all his arrears for a defined period of time, the customer performs satisfactorily. At that point, you're permitted to upgrade the customer from stage 3 to stage 2 or stage 1, depending on the delinquency of the customer. So basically, the IFRS 9 model is a symmetrical model. At the time of restructure or negotiation, since you're offering a financial relief to a borrower due to a difficulty, at that point, you're required to stage the customer into stage 2 or stage 3. But when the customer resurrect themselves through constant repayment, then you are required to upgrade the customer also in line with the relevant risk management practices. So basically, if the customer starts repaying and settling the arrears and fully settling the loan, you will see gradually the customer will come from stage 3 to 2 and 1, which will lower the provision recognition also. So that's the common requirement under IFRS 9 when it comes to application of staging. I hope that clarifies your question. If there is further, we probably can take it at the Q&A session and we will clarify at that point. Right, so the next area is on the loss given default. So the loss given default, we see the predominant functionality would be trying to recover the loan from the defaulted customer. So basically, your objective is you're trying to evaluate how much of recoveries have been made from the defaulted customers in the past. So rule number 1, your loss given default will only click into stage 3 customers. If you look at the equation, probability of default will apply the propensity to get into stage 3, and loss given default will apply the recovery from stage 3. So that's an important relationship that you have to maintain in the model. So your loss given default will only click in when the customer is stage 3, because then the customer has defaulted in line with IFRS 9, and then you're required to monitor constantly the recoveries of that customer. So probably there is strenuous data collection process required, because which means that you need to go back to your co-banking systems, monitor customers who exceeded 90 days in the last 5 years, get their collection cash flows, calculate the recovery rate, and calculate the loss rate. So calculation is very straightforward, but data extraction can be quite painful because of the fact that most of this data is maintained as backups. You probably will have to restore your backups and probably take these cash flows. You cannot consider the same LGD that you use for IAS 39 purposes because of the difference in the default point that we see. Under IAS 39, most of you may have used the default point of 108 days, 365 days, or sometimes even 540 days. But now the default point is advanced up to 90 days. That's your stage 3 click point. And then your recovery cash flows will start from 90 days onwards up until the point of recovery. So that's a significant a challenge in terms of the data collection. But in terms of the calculation, it's a very straightforward calculation because you will present value all your recovery cash flows and compare with the outstanding value. So for example, if you have 100 rupees outstanding and the present value of recoveries are 80 rupees, your recovery rate is 80 and your loss rate will be 20%. So that's a straightforward calculation, but the data gathering process is a little challenging. So when it comes to exposure at default, like I said, it's the amount which is outstanding at the date of default. So depending on your customer runs a term nature product or a revolving nature product, how you model the exposure at default will be different. So you can see if you have a term nature product, you will underwrite first and the customer is required to settle over a period of time. You can see the outstanding balance gradually drops, which you need to model in. That's a little bit of an easier calculation because in all your core banking systems, you have the payment structure, remaining payment pattern of your individual borrowers. So you can actually forecast how much is going to be outstanding of this loan at each reporting date to the next 5 years or next 3 years, depending on the life of the product. But depending on the revolving nature, depending on the nature of the product, if it's a more of a revolving nature product, such as credit cards or overdrafts, it can be quite challenging because you don't have a repayment pattern, you don't have a structured repayment cash flows. Instead, your repayment can vary depending on the amount of utilization and various other parameters. So when you have revolving nature products, it's quite challenging. You're required to calculate not only the future limit utilization of some of these products, also you have to factor, depending on the macroeconomic volatility, how this utilization would vary. So that's also an important parameterization that you require to consider. So for example, if you take credit cards, today you might have a card which with outstanding balance of 500,000, you have not used anything at all. But if your risk is going to increase, if you're going to default in the next 12 months, probably you might use some balance of this card. So the banks require to evaluate this utilization pattern of the defaulted customers. So for that, again, banks will have to study the last 5 years utilization pattern. You're required to gather the data of the defaulted card holders. I'm sticking to my same example of credit cards. You gather the data of the last 5 years for defaulted card holders and monitor their utilization pattern from the grant date leading up to the date of default. And then that sample will reflect you that depending on the type of the card, you will have a certain amount of limit being utilized prior to the date of default. The segmentation is again becomes critical because if you're looking at an entry-level card, there can be higher utilization in case of a default compared to a premier level card. So this results in an additional implication of balance sheet limits that are kept currently. Some part of it will be considered for impairment provisioning purposes. With the anticipation in the next 12 months, some of these limits will be used by the card holders in case of a default. So there's a distinct difference between IAS 39 and IFRS 9. IAS 39, we did not have this complication because it was incurred loss. So all what was used today, we had the presumption has been defaulted and we took the amount outstanding today. But since it is expected credit loss, we can't simply get into that presumption. Some part of your off-balance sheet limits will be utilized by the customers, and for those you'll have to maintain adequate provisions for. So that means that some part of your off-balance sheet will end up getting provided. So all your limit-based products, you will have the implication, your credit cards, overdrafts, trade finance, project finance loans, etc. All of your limit-based products, you will have to consider the utilization pattern. So this creates, I think I spoke of heavy interconnection between operations and finance. So this creates a little bit of a challenge because most of the banks in Sri Lanka at the date of transition, as well as in other countries, you had to provide for significant proportion of off-balance sheet limits because for cards, on average, your credit conversion factor was 70 to 80%. If it is an entry-level card, even sometimes it may be high as 100%. If it's a premier level card, we saw it's about 50 to 60% credit conversion factor on average. So meaning off-balance sheet limit up to a maximum of 50, depending on the type of the card, or maybe even 100, will have to be considered for provisioning. So that can cause additional pressure in terms of transitional adjustments, because at the date of transition, all of that component of provisions will come and hit your retained earnings, which will have a significant challenge in terms of tier 1 capital. So then the next question is, how do we manage this? Of course, you need to increase your robustness in terms of monitoring without waiting till the cards to get into 90 days to freeze the limits. The banks will have to identify mechanisms to deploy temporary limit blockages in interim periods as and when you see customer risks have been deteriorated. So Sri Lanka, right now, we see most of the banks, after 30 days, they put temporary limit restrictions where the limits cannot be drawn down if the cards have gone into more than 30 days in arrears without waiting till the 90th day, because the moment you wait till the 90th day, chances are you're allowing a larger window to perform the utilization of the limits. So you're trying to restrict that loss emergence period. Certain banks we see use analytical risk management techniques such as behavioral scorecards, deploy behavioral scores based on the pattern and the type of utilization, repayment pattern, whether the card is a settler or a revolver, depending on how the repayments are structured. You rank the customer. If the ranking is shifting more towards moderate to high risk zone, the banks will take immediate action to block the limits temporarily, especially with the retail portfolio. So those have helped the CCF limits to be brought down, especially when it comes to credit cards and various other products. So then forward-looking macroeconomic assertion will be important, similar to probability of default, loss given default, because like I said earlier, we have extracted last 5 years of data. We have run the algorithms for last 5 years of data. That has nothing to do with expected loss. Only point of expected loss determination is by looking at economic factor adjustment, where you will convert some of your historical stats to more forward-looking variables. So starting point for your economic factor adjustment, in short we call EFA, is your macroeconomic variables, which includes your GDP, inflation, interest rate, foreign exchange rates, etc. But if you ask me the question, is that the only way to do it? Answer to that is no. I think I stressed on this earlier as well. Certain products, certain customer segments, certain target markets, your macroeconomic variables may not define your expected losses. So for example, if it's an agriculture portfolio, it has nothing to do with GDP, but probably with the rainfall or the weather pattern. So there could be different products which are sensitive and linked to different types of indicators as opposed to macroeconomic indicators. But the starting point generally is the macroeconomic indicators, but the banks will have to assert which indicator reflects best for which type of product, and then build your economic factor or forward-looking parameters. You probably have two ways of doing it. Standard permits two approaches. One is a single outcome approach. The other one is a multiple outcome approach. Well, for single outcome approach for countries in Southeast Asia, similar to Sri Lanka and other countries, generally is not recommended to go for a single outcome approach, because it's very difficult to forecast our economic outlooks with greater certainty. Because if you look at the past, some economic conditions have been quite volatile. You'll see quite a volatile Z or S type of a curve if you plot some of your macroeconomic variables, which means that your forecast is not going to be quite accurate if you go into a single model outcome. But countries which are more developed, which has more stable economic condition, probably where you can predict your macroeconomic condition with reasonable certainty, probably can consider a single model. But in Sri Lanka and most other countries, we use the multiple models assessment, where we have 3 scenarios minimum, where economy is evaluated under the base case, best case, and the worst case, where the outcome is weighted on depending on the 3 scenarios that will be built in. So those are the important consideration. Well, again, you will see lots of different models in doing the EFA. If you look at the standard does not prescribe the model. All of these are coming from global risk management practices. That's what I said. There need to be some degree of integration between your risk management as well as IFRS 9. These methodologies that we use to develop probabilities of default, loss given default, your macroeconomic conditions are not prescribed or recommended in accounting standards. These are stemming from global risk management requirements, especially when it comes to credit risk management. So stress testing framework is one starting point for your EFA. So most of the countries, for capital adequacy assessment purposes, you do a stress testing scenario and assessment. It's a starting point, but that's not only way to do it, because if you look at a stress testing framework, your objective is different. Your stress testing framework objective will be to assert more stress and see whether the bank has adequate capital to meet or continue in business under those stress conditions. But objective of EFA, or the economic factor adjustment, and IFRS 9 is not only to exert stress. That's why I said we do multiple scenarios. We do the best case, we do the base case, and the worst case. So best case considers the probability of the economy to improve, or the conditions or the environment to improve. Base case considers the probability of the conditions to continue as it is, and the worst case looks at the probability of situation deteriorates. So you need to integrate some of these existing risk management approaches and then look at how best you can come up with an assessment on the economic environment. Be mindful if you're using regression or logistic regression type of models, because countries where the macroeconomic variables are quite volatile, if you directly use any form of regression analysis, you might end up getting significant volatilities into your expected credit loss answers, which may not be able to be justified in your business as usual conditions. Because, for example, if you look at in most of our economies, the last 5 years, you see the GDP spectrum ranging from negative to positive. So if you look at Sri Lanka, they've been negative for long years, but right now we are almost touching the positive side. So meaning every time your macroeconomic variable changes, depending on the coefficiencies of those variables, it can drive a volatility into your expected credit loss numbers. So if you're from a volatile economic environment where GDPs, inflation, interest rates have fluctuated significantly, your regression is not the way to go forward. You probably need to look at an alternative approach, such as a scoring method where you score multiple variables, you blend it, and then you use average score to determine your expected credit loss mechanism. So EFA determination is also critical. Depending on the country, depending on the type of portfolio, it can have a significant impact. Right, so I have spoken about this in multiple instances in my previous slides. I will leave this slide with you, so I'm not going to talk about this in detail. But just to leave a very short remark, this is where your integration is most important when it comes to risk management. One thing that we saw as a significant challenge when adopting IFRS 9 from a banking point of view is that in our parts of the world, banking is collateralized lending. So when you have a collateralized lending, generally the monitoring becomes weaker because you have the comfort of the collateral. So when the monitoring becomes weaker, the staging process gets negatively impacted because, see, traditionally, if you look at Sri Lanka and most of the other markets, the recovery teams or risk management units not necessarily gets activated before facility goes into NPL. So in Sri Lanka, if you look at, which is very close to my a hard and reality, which we had NPL rates shifting dramatically closer towards the year end and again deteriorating towards the mid. So, for example, we have a December year end, Q4, you see a steep drop in NPL, and Q1, Q2, you see a steep rise in NPL because the entire recovery follow-up risk management was driven based on the NPL parameterization. So that is because we were never activated when the facility goes into 1 month or 2 months in arrears, essentially because sometimes we have the collateral. So that weakens the credit monitoring perspective in between the time of underwriting up to a point of default, which can result in adverse staging at the time of transition into IFRS. So gradually these needs to get ironed out. That's what I said. There has to be a heavy integration in terms of your credit underwriting, monitoring, risk management, and IFRS 9 reporting as well. So some of these will have to get integrated. So some risk management techniques such as early warning signals framework, behavioral scorecard framework, customer scoring, customer rating methods are required to be looked at properly in terms of IFRS 9 implementation with the intention of improving portfolio quality and its performance. Well, I'm not going to go into very much of detail into this because that's more towards credit risk management as opposed to IFRS 9. But I will leave it out to take any questions at a later point during our discussion. Lessons learned is basically, these are the key highlights: governance, data. External audits will have to get streamlined and strengthened because these models will change overnight. Most countries will adapt IFRS 9 this year. I know for a fact Nepal will adapt IFRS 9 this year. And most of the other countries have transition which takes place this year. So you will have to have a proper reporting operation and approach towards modeling. So I will not go into detail in the interest of time, but I need to touch very few finer points in terms of financial asset classification. I don't intend to go into this detailed academic conversation, but a few things that you need to keep in mind is that when it comes to financial asset classification, common questions that we have is, especially when it comes to debt instruments, in our part of the world, most of the time, debt instruments will pass SPPI test because our instruments are more straightforward, simple. It carries characteristics of contractual cash flows as defined in the standard, which are repayment of capital and interest carrying three broader functions of time value, credit risk, and intended profit margin. The problem becomes in the assertion of the business model in most of the instances. So there are three business models in the standard. You have the hold to collect business model, hold to collect and sell business model, and you have neither hold to collect nor sell. So those are the three business models. So hold to collect business model, our intention is you're trying to hold the instrument to collect the contractual cash flows, though. So the sales doesn't play a pivotal role in this business model. Well, the sales can be there because the common question that is asked is, cannot we have sales? Yes, sales can be there as long as they are insignificant or infrequent. So either the sales has to be insignificant in value, even if they are frequent, or even if it is significant, it has to be infrequent. So that is the important consideration. So at the date of transition and even after transition, you're required to define what is insignificance and what is infrequent. How do you define significance and how do you define frequency? This will again depend on the size of the bank, bank to bank. This will vary as to what is significant and what is frequent. So business models with the objective of collecting contractual cash flows and selling financial assets. Another important consideration that I want to highlight is here you need to have both intentions. You want to hold the instrument for some time until the instrument gets the right return. At that point, you're planning to sell it. So in this business model, sales are an integral part of the model. However, you need to be mindful that you don't do short selling using fair value through OCI or hold to collect and sell business model. When I say short selling, you can't have instruments churning out quite frequently within a period of less than 12 months, because your intention has to be holding as well as selling. Whilst you manage this, you need to keep in mind is you're managing a portfolio, you're not managing instrument individually. So when you manage a portfolio, as long as the common portfolio characteristic reflects this dynamic, broadly you meet the requirements of the standard. So it's not the individual instrument that you will manage, but while reflecting the common portfolio characteristic, you need to reflect that you hold the instrument and sell, and both characteristics are combined. Common instruments that can go into the second business model is only treasury bonds, most of the instance in this part of the world. There's no other instrument that you can put, because you can't push anything similar to a fixed deposit or a loan and advances into the second business model, because it does not have the ability to sell. It's only the treasury bond, treasury bills, because of the short-term nature, whether you satisfy the objective of holding until such time unless the market dynamics permit you to do so. Most of the time, treasury bonds will qualify, but treasury bills can qualify depending on how the secondary market dynamics in your respective markets are. So the third business model is fair value through P&L business model. And also one thing important that we need to keep in mind is, despite of the business model, under the debt category, you present your instruments at fair value if you believe the fair value is a better reflection of your balance sheet. So you can see that even under debt model, hold to collect business model, hold to collect and sell business model, you have a conditional fair value option that you can elect. It becomes an accounting policy choice, but it comes with two conditions. It only available to you at the inception, and that condition is irrevocable. So basically what it tries to tell you is you cannot change it from time to time. It's only available to you at the inception, meaning the day that you enter into the transaction or day that you enter into the deal, and you cannot change it back subsequently if you elect that fair value option. So if you elect the fair value option, despite of your business model, you can measure that at fair value through P&L. So the broader concept of IFRS 9 is it encourages as much as possible to measure your assets at fair value, but it brings in the fair value condition to avoid manipulation, because otherwise what will happen is during periods of overperformance of certain markets, you will push to the fair value option, and during underperformance, you will revert back to a different business model. Derivative, it have to be fair value. There's no big change. But when it comes to equity, one thing that you need to keep in mind is, again, all the equities intention is to measure at fair value through P&L, despite of trading or otherwise, except for the ones that you measure using the fair value through OCI option. That is because, again, for equity, you're given accounting policy choice to measure the equity at fair value through other comprehensive income. If you elect that option, again, it's only available to you at the inception, and it is irrevocable. You cannot change it. The same condition that I discussed will exist. But the only difference is for equity, if you elect the fair value through OCI option, it does not permit to recycle once you dispose. Once you sell one day, the realized capital gain or loss will not be permitted to taken back to P&L. Whereas in debt instruments, you're required to take your disposal gain or loss back into P&L. The reason for this differential treatment between debt to equity is a unique nature, which is resulting from impairment. Because if you recall IAS 39, for AFS, there was a requirement to provide for impairment when there is a significant or prolonged decline in fair value. IFRS 9 have removed that requirement. Now you don't need to make any provisions for impairment for equity. Therefore, that's the same reason when you present it under fair value through OCI, you're not permitted to take it back any gains or losses to the P&L. Despite for debt instruments, you permit to take the disposal gain or loss to P&L, because debt instruments are required to recognize the impairment losses in their P&L. So that's a notable difference between the two items of debt and equity. So with that, I think the time is up for me. There'll be a couple of questions I'll very quickly take, and I'll hand over the proceedings back to the Institute. The answer is, when you don't have the accrued amount on the face of the balance sheet, especially this question is in terms of off-balance sheet limits, there is a requirement to recognize the ECL. Yes, answer to that is yes, but the presentation under IS 1 is required to recognize that as a provision, not under the deduction from the loans. So normally ECL goes in as you have the amortized cost, then you have the impairment provision, then you present net of impairment provision under the asset side. This will go under the liability side as a provision. It will not, because it's not on balance sheet, it's not made under as a deduction from the existing loan balance. It's rather presented as a provision separately, just like how IS 37 provisions are being made. So you don't have that commitment or drawn balance reflected on the asset side, but you will separately show that as a provision. Principal is 100, accrued markup is 30, undrawn markup is 20. Why should we calculate ECL on 150 when we have recognized just 130 in the balance sheet and remaining 20 is not accrued? It's true that remaining 20 is not accrued as of date, but that 20 can be utilized in the next 12 months. If the customer goes into a default, you have given that committed line to the customer at its discretion can draw down. So then these unutilized limits, the bank runs a risk. Since you have already approved and allocated that to the customer can draw down during that specified period of time. So you need to assert that ability to draw down and use that as credit conversion factor. But the good news is if the customer is not likely to default, you will not absorb that entire 20. So for example, you always combine your EAD with the probability of default and the loss given default. So for example, let's say you have a EAD of 100. If the probability of default is only 1%, you will only attract 1% of that 100. You will not provide for the entire amount. So if your probability of default increases, meaning then you are looking at a larger provisioning ability for the off-balance sheet limits. But the logic is you have given an unconditional commitment to the client, which he or she or the company can draw down during a stipulated time period. Are there alternative approaches to calculate LGD without looking at recoveries? Well, there are different approaches, but only problem is your recoveries are the ones which are closer to reality. That will reflect the strength of the recovery strategy that you use, because banks will use different recovery strategies, different recovery channels. Unless you start off your calculation with your actual recoveries that have been made in the past 5 years, your answer will not be closer to your business model. So that's the bigger challenge that you have. So if the data, there are limitations, of course, we use certain workarounds when depending on the type of limitations that you may have. But generally, we evaluate the starting point as the respective bank's recoveries itself to reflect the business model of the bank itself. That's the reason why you're required to look at your historical recovery patterns. Can you share the soft copies of the slides? I think I should be able to share the PDF version. I will make arrangements to share the PDF versions of the slide. I think with that, we have concluded all the questions that have come on the Q&A. I think any other question will answer in the live environment during the Q&A session. I will now hand over proceedings back to Shanta. Shanta, over to you to commence the Q&A session.
Thank you very much, Mr. Rajitha, for sharing your expertise knowledge, IFRS 9, and the excellent presentation today. And moving forward, let me introduce and welcome our panel members for the panel discussion. Mr. Surendra Shestra, Partner RS and Associate Chartered Accountants, Council Member of the Institute of Chartered Accountants of Nepal. And Mr. S.K. Ashik Iqbal, Partner Deloitte. Mr. Arslan Khalid, Partner EY Ford Roads, Pakistan, Council Member, Institute of Chartered Accountants of Pakistan. And Mr. C.A. Pramod Jain, Council Member, Institute of Chartered Accountants of India. And today, the panel discussion will be moderated by Mr. Manil Jayasinghe, the Chairman, SAFA Accounting Standards Committee, Securities and Exchange Commission, Director, Board of Investment, Governing Board member of the Central Bank of Sri Lanka. Over to you, Mr. Jayasinghe.
Thank you, Shant. Yeah, thank you, Shanta. Good evening to everyone, to my esteemed panelists, and to Rajit, to thank him for a very exhaustive and in-depth presentation on IFRS 9. Sometimes after listening to that, you are also getting confused as to how this standard, the application of the standard. So in order to share their experience and their knowledge around South Asia, we have this esteemed panel. So we have Mr. Pramod Jain from India. We have Surendra Shrestha from Nepal. We have Ashik from, I think, Ashik from Bangladesh, right? And we have Hassan Khalid from Pakistan. So first of all, if I can turn to you, Pramod, probably I think each other panelists, it would be good to just take a few minutes to tell us the status of implementation of IFRS 9 and maybe some general comment about some of the things that you have seen before I sort of go into the specific questions. So if I could first go around just asking each of you all to share with us your first of all the implementation of IFRS 9 in each of the countries, and also next is any big challenges that you're facing, and then we will probably go into the specific areas of specific questions that I have. So can I ask Pramod to sort of kick off the session and make his comments?
Thank you, Jayasinghe. In fact, namaste to all, and thanks for inviting me to be panelist on this very important forum. If I talk about India, of course, India has not implemented IFRS as it is. In India, we have converged. So in India, when we talk about it is converged as Indian accounting standard. So we call it Ind AS. So yes, India has already converged to Ind AS, IFRS. And here, if I talk about various financial statements which are being audited, so overall, if I say there are around 5 million audits done in a year, the entities who are required to comply with the IFRS Ind AS are approximately 27,000, which includes listed company. Apart from listed company, I would say even those companies whose net worth is more than 250 crores. And even if they are unlisted, they become unlisted thereafter, delisting thereafter, they still have to. Once you have applied for the IFRS, then you have to continuously apply. So here in India, if I talk about the two important sectors are yet to implement IFRS, which includes my IFRS 9. Because in here India, when the IFRS is implemented in days, then it is implemented in total, all the standards which are there. So two sectors which are very, very prominent who are yet to implement is one is insurance and second is banking. So IFRS 9 is most important for these two sectors. But of course, all other sectors also, but these two important sectors are yet to implement IFRS 9. We are hoping that they would be implementing it soon. Right. Thank you.
Thank you, Pramod. Can I ask Surendra to also share with us, because I think they are in the throes of implementing 9 this year. So maybe he can share with us some of his knowledge.
Namaste and good evening to all. Yeah, the Institute of Chartered Accountants of Nepal has pronounced the adoption of IFRS 9 from 21st July previously. But considering the complexities related to these ECL recognition and the effective interest rate method, the institute has provided the carve-out up to 2023-24. Now, this is the year, now coming July 2024, it will be mandatory for all the entities, preparers, to fully implement the IFRS 9. So, in these circumstances, the Central Bank of Nepal, the Nepal Rashtra Bank, also has issued recently the guidelines related to the expected credit loss, stating the procedures regarding PD, LGD, and EAD. So the most challenging part is the accumulation of historical data. So still, the commercial banks, development banks, finance companies, and microfinance companies are still in the process of implementing the IFRS 9 model. They are now starting the procurement procedure for getting the right resources for this project implementation, but still the entities or the banks or the financial institutions are not so much confident, because it's the first of its kind in Nepal to adopt this IFRS 9. So the situation is like, we'll bail the cat first. So also, in fact, also the current economic situation regarding the SMEs and all the business or the economical circumstances of Nepal is not so promising. So the stakeholders are in doubt whether the expected credit loss model will also again increase the loan loss provision. So they need to face the shareholders after implementation of this issue. So now almost the journey has been started. Let's hope for the best. And after few months of period, the most of the bank, A level of commercial banks will most probably implement the IFRS 9 successfully. Thank you.
Thank you, Surendra. So next, if we can go to Ashik to share his experience and the country's experience.
Good evening. Thank you, Mr. Chair. So in Bangladesh, accounting standards were originally adopted and issued by ICAB, the CA Institute, but in 2015, Financial Reporting Act was promulgated and a separate regulatory authority, Financial Reporting Council, FRC Bangladesh, was set up. So FRC has been tasked with issuing and adopting accounting standards, and we have adopted IFRS as issued by IASB in Bangladesh. So technically all public interest entities, so we have like both listed PIs and non-listed PIs based on FRC threshold. So all of these entities are required to follow IFRS, including the banks and finance companies. But however, Bangladesh Bank, the central bank, they came up with their own guidelines, which is not in line with IFRS 9. So even though the regulatory framework requires IFRS 9 compliance and other IFRS compliance for banks, but with respect to IFRS 9, banks and finance companies, they have their own set of standards based on the central bank guideline. So the regulators are now sorting out a transition or a pathway for the banks and NBFIs in Bangladesh. So in addition to bank and finance companies, another sector that is that is supposed to be significantly impacted by IFRS 9 is microcredit institutions. As you know that Bangladesh gave birth to the concept of microfinancing. Some of the largest microfinancing institutions are located in Bangladesh. So they also have their own regulator, which is called Microcredit Regulatory Authority. Unfortunately, they have also came up with their own set of guidelines, which does not go in sync with IFRS 9. So I would say that these two industries, bank and finance companies and microcredit authorities or microcredit institutions, they have their own set of standards, and regulators are like having a lot of discussions and dialogue. We hope that in near future we will have full IFRS 9 compliance for these two sectors. Thank you.
Thank you, Ashik. Next we'll go to Aslan. Can you please sort of give us a briefing on how?
Thank you, Munir. It seems that the landscape across the region is more or less consistent. Like in Pakistan, I think I can tell you that we, as a reporting regime, we follow IFRS, and that is adopted by the SECP, and we have an accounting standard board within Institute of Chartered Accountants of Pakistan, who recommends the IFRS standards for adoption by the SECP in Pakistan, so that they become legally enforceable. So IFRS 9 was adopted a few years back by the SECP, but like other jurisdictions in the region, I think the central bank in Pakistan, came up with a carve out of IFRS 9 because of their own regulations and determining the regime for provisioning, which was based on incurred loss model. And that continues, but at the same time, the central bank issued a requirement that while IFRS 9 is impending, the banks should also report on parallel to the central bank the impact of IFRS 9 on a quarterly basis. So the quarterly parallel run started 2019 or 20, and it continues, but very recently, I think the standard has taken effect. So the central bank has now enforced the standard from 1st of January 2024. So as we speak, the standard has become effective in Pakistan for the banks as well. But we still have to see the first year end of December when we'll see the audited financial statements under IFRS 9. So the first quarter reporting in 2024 has happened under IFRS 9, in Pakistan for the banks. And during the last few years, banks have been regularly reporting the impacts to the central bank only. So the purpose was to prepare them for the live reporting, which started in January 2024. And another important and interesting thing that the central bank has done, they have issued application guidance on IFRS 9, which was issued last year, and also some disclosure requirements, the model financial statements, how they appear under IFRS 9. So those are have been issued so that the industry have some consistency when they develop models for IFRS 9. And so this guidance obviously also talks about some relaxation on the impact of IFRS 9 when it comes to the capital adequacy of the bank. So the transition relief has been allowed that in the first year, the impact will not be taken 100% on the capital adequacy. It can be transitioned over a period of 3 to 4 years. So that is also a concept which has been introduced through the application guidance. So all in all, the position is that we have started to implement IFRS 9 in 2024, and we have but yet to close the full year, in this year.
Thank you, Adnan. Thank you. So if I may sort of, I did send you all some questions, but given the diversity in the application of this, if I may ask, let's say Pramod, when you expect this to be implemented in the banking and insurance sectors, because those two sectors, I believe, are the most impacted sectors by IFRS 9. What do you consider to be the sort of the biggest challenge that these institutions will face in the light of applying IFRS 9? You're on mute, Pramod.
Thank you, Jasindi. In fact, in India too, the process what is there in Pakistan, that the banks have been preparing since past 2-3 years on a parallel basis. The IFRS India-based financial statements. Insurance companies have started. In fact, if I talk about my non-banking finance companies, NBFCs, they have already implemented it. The large ones, the listed ones, and the 250 above net worth crore companies, they have already implemented IFRS. So IFRS 9 is also implemented by them. But bankers, of course, they are facing that challenge of the problem it would be there on converting from what I say to the expected credit loss method from the existing realized one. So here they are facing a problem, and then there would be a problem on the capital adequacy, because similarly it would be there on the insurance companies. In fact, in India now, 117 is soon to be notified, and we are expecting. We are having a talk with the insurance regulators regularly. The Institute of Chartered Accountants of India. We are having a combined meeting with those regulators, and they are very much aligned. We are hoping that within a year or so, the insurance companies, all the insurance companies will be complying with the IFRS 9 and 1172 out there. And banks, we are persuading that they should come out very soon. And of course, the regulators, Reserve Bank of India, will have to first notify the same.
Thank you, Rohit. Surendra, if I turn to you again, I am not necessarily going by that set question. I'm going by what Rajit presented to us and the challenges that you have. One of the biggest challenges from Rajit's presentation, I gathered, is data. So in case of data, two or three things that involved is, one is the quality and the clarity of data, because you're going back in the past, you're collecting this data from the past, where when you collected that data, you never had an intention of using that data for determining the ECL calculations. So obviously there is some degree of, how should I say, the data to be not necessarily fit for purpose. So how do you all think that will be addressed in your drive towards implementing IFRS 9 in 2024?
Yeah, thank you, Moni. Now, this CL required, basically I will talk about the expected credit loss model, because the main challenge is itself, the ECL itself. So for the building of ECL model, we need some transaction historical data regarding the flow rates, delinquency buckets. So in our scenario, while having some conversation with these banking executives and the resource persons who are our professional members, they are looking for the past data up to the 5 years back from the now current period. And also the central bank has issued the guidelines mentioning that they can go at least from 5 to 7 years of historical data for the analysis of flow rates, or to say you get the right information about the loss given default, or we need to get the exact data regarding the recovery rates also. So for each buckets or each stages, let's say from each month to next month, how what percentage of these loan has been classified to the default zone. So basically now, in case of Nepal, still we don't have a validation of credit rating, internal credit ratings, right? Basically the banks have their internal rating, but it is also not validated. So to get the exact information regarding the financial discipline of each borrowers, it will be a quite challenging job. So that is one aspect, getting the back data, that is the major challenges. But if we can access the core banking software regarding the individual customer behavior or portfolio segmentation behavior, then it could be quite comfortable for bank and financial institution to get the job done. So, and next challenge is what I have seen from the regulator or the institute perspective, that is a forward-looking information and especially the macroeconomic indicators. So the guidelines also states that at least 5 macroeconomic indicators need to be adjusted to get the point in time data for the calculation of expected credit loss. So, getting that macroeconomic data like gross domestic GDP or unemployment rates or other inflation rate, and the adjustment is also, I find, very challenging. So the basically being an IFRS 9 a forward-looking required information for the calculation, we and also the banking institutions are looking for the best resources from the software point of view or from the skill resources. We are trying our best, but I don't know, it's the first time we are getting into this implementation, but after a year of implementation, only I can say that how much we will be successful regarding this implementation. For now, we are somehow adjusting or having utilizing the available information for the time being right now. Thank you.
Thank you, sir. Thank you very much. So if I go to Aslan again, you all have hopefully will see the signs of IFRS 9 being implemented in the current year. So you discussed again. I may like to ask you 2 things. One is as you can see, the data and the data validation and the data governance is going to be one big issue. And the next issue that is going to come about is also the expertise that you have. Some of those models that Rajit discussed about, how you do calculations on data, PD and LGD and EAD. Some of the, it requires a little bit of an expertise. So how are we building that expertise given the requirement to implement the standard law?
Yeah, certainly. Obviously, what we have seen in Pakistan for the last few years when the parallel reporting started, so the banks did engage with the accountancy firms to run advisory projects on IFRS 9 in terms of both, developing of the models, because, the capacity within the banking sector was there, but I think it was fragmented with the risk and finance. And obviously the methodology, they were not fully conversant with the IFRS 9 methodology. But over time, what has happened is obviously, I think in most of the banks, especially the larger ones, they have been able to develop the IFRS 9 models. IFRS 9, I think, is a very data-intensive exercise, obviously, and it depends on how much data that you possess and the quality of the data. But in fact, I think the application guidance that the central bank has issued, based on the reporting that the bank was receiving from a various banking sector. So I think that helped in developing a broader guideline for the banks to help them, develop those models. For example, there were areas where complex modeling was required, but I think some simplification has been allowed, like for LGD, where the banks have not been able to retrieve their historical loss experience or historical recovery data. So for initial 1 year, I think banks were allowed to use the Basel proxy of 45% LGD till the time they are able to develop those models. Similarly, for CCF, the credit conversion factors, I think that was also allowed to be taken from Basel till the time banks have developed their own sophisticated models based on historical data. But on the PD models, I think most of banks are now using transitional matrix approach and have been able to develop PD models. Obviously, refinements will be required in those models as we move forward, because because of various kind of other information that perhaps needs to be taken into consideration. But I would say a reasonable level of models have been established by the banks to come up with the PD, LGD, and EED estimates, and then the concept of IFRS 9 obviously is around the core principle, and the core principle is that development of a forward-looking dynamic model to estimate the expected credit loss. And there are three ingredients that are required in those models. A, it should be based on a probability theory. B, it should be incorporating the time value of money, and C, it should be it should be forward-looking in its approach. Now, IFRS 9 is not prescriptive on what models to be used. So the idea of using a model is basically to implement those concepts. And I think, as we say, one size does not fit everyone. So smaller banks may have simpler model, like microfinance banks can have simpler flow rates to develop the estimates of ECL. And as they move forward, they have more data to refine those models. But I think in our part of the world, obviously, we are dealing with simplistic kind of financial products, like loans are plain vanilla loan products. We have in most of the cases, we don't find issues with the SPPI test, and the business models are fairly clear. So I would say that the most of the ECL models that we have are built on reasonable amount of data that we have. But yes, there is a lot of room for improvement. So like we still have to go for internal credit rating validation checks, because the base of those models, PD models, is the internal credit rating that is assigned and the scoring system that the banks are using. But very few banks are validating the robustness of those internal credit ratings. So those kind of refinements and validation checks, I think, would occur over a period of time. But the estimates that the banks are coming up with based on the models, I think in the overall sense, they are consistent. And I would say, for a starting point, it gives you a reasonable picture of the ECL positions.
Thank you. Comprehensive area you covered. Thank you very much. And Ashik, if I were to turn to you, so Bangladesh is still, I think it's in the process of implementing IFRS 9. And I think your Reserve Bank or your central bank is in the process of taking on board the requirements of IFRS 9 and issuing, I suppose, guidance or regulations, whatever you may call. So once again, once they issue this, I raise the same question. So everything is going to go back to data, the availability of data, the sophistication in the models that you are going to use in order to capture some of these requirements for the ECL model. What do you think are the challenges in implementing 9 in your context?
Thank you. So as you rightly pointed, the banks and NBFCs, they haven't been using this, but other than banks and NBFCs, they're complying with IFRS 9. But the implication is not comparable with banks and NBFCs. Having said all of this, so some of the challenges that the learned keynote speaker presented and discussed, the bankers, they have also voiced similar challenges. So if I summarize, I would say there are 3 aspects the challenges will hinge upon, and the readiness of the banks and NBFIs will hinge upon. One is data availability. We have significant challenge in this area. And then modeling sophistication. There are a lot of questions and comments and concerns, and then governance. So this governance component is particularly important because we have a lot of struggle in respect of the governance component. If you look through the media reports, you will find it. So the integration of these three aspects is extremely important in dealing with the challenges in the days to come. And another aspect is extremely important, and this has been highlighted by the keynote speaker, that is the collaboration between the risk management and the accounting and the finance team. So these are the key areas, I would say. So we have to focus and concentrate on these key areas, and we have to learn from the experience of our neighboring countries and from the global arena. Yeah.
One of the challenges, I think, I'm just opening out, so anyone probably can know. One of the challenges is going to be the accounting systems itself. Say, for example, Rajit mentioned now, when you go into stage 3, you're going to account it on a net basis. You carry the cost at a net basis, and you account for income or whatever it is on a net basis. But on the other side, from a legal perspective, your recoverability is on the legal contract, which is the amount that you have to recover. So how do you sort of foresee that you'll have to have like a dual accounting system where to the customer you'll have to show you have to pay X amount, but from an accounting point of view, you are only going to reflect a different number in your books. So you have to have this dual, how should I say, dual reflection. So how do you see the systems, the accounting systems will handle it? Because even if you take the EIR calculation. So based on EIR, I think there was a question earlier about the staff, where you give loans below market and you carry the value at fair value. Your fair value is not going to be the contractual value. So your system will have to capture both. For financial reporting, it will have to carry the fair value, but for recovery purposes, it will have to carry the contractual value. So how do you foresee that this is going to impact the systems, the IT systems, the accounting systems that the banks and such institutions have? So if I can just ask each one of you from your side what your views are. If I start with Pramod, what is your...
Here, we are talking about validating the models for the ECL, and apart from that, of course, there is certain times the issues relating to classification of the financial assets, different categories based upon the characteristics of the equity model, equity of that business entity. But here, when you're talking about how they would account for such, in fact, in India and maybe in our neighboring countries, all bankers have been doing it by, through their IT systems, where in the case of provisioning for the non-performing assets, they don't recognize the interest in their books in the financial statement, but keeping subsidiary ledgers where they keep on charging with the customer. So they're already doing it. And in fact, if I talk about currently, I hope other countries are also having the same thing, that for the banks now, the provisioning which is required based upon the standard assets or the substandard assets or the non-performing, performing, so it is rule based. So, okay, this much percentage, if this conditions are met. Now, here, when would be expected credit loss, the quality of the data that can be used to forecast the future credit loss, it is a very, very, very big issue, depending upon case to case, bankers and their systems. But having the issue which you are telling, what I feel so is inbuilt into the system, so that should not be posing a problem in India.
Thank you, Pramod. Azran, any comments on that?
Yeah, I agree. I think this is the same with us, because income suspension happens when you have an impaired loan or an NPL loan, and still banks maintain a memorandum record of the interest that continues to accrue. But I think from a system point of view, there are other challenges, because we are using not just the accounting system, we are using risk management systems, credit monitoring systems to have data into those models. The issue is that the ownership of those systems reside not in finance typically, it resides in the risk departments of banks. So the stakeholders are not only the CFOs, the stakeholders are also perhaps the risk leaders of the banking of the banks, etc. And also there has to be a multi-stakeholder kind of a collaboration in order to come up with the right estimate. So data that we are talking about, that there is absence of data. The issue is that the data may be there because in a banking model, you must have some mechanism to monitor the credit risk. So if you, as a business, if you're running a bank, you would have some credit risk management mechanisms. You would have some ways to explore at least your historical loss rates on your portfolio. You would have some kind of a measures to determine or distinguish between your good customers and bad customers. You would have some kind of a insight into how those customers are categorized in terms of their credit risk. Now, that has to be translated into an IFRS 9 model. So if a bank talks about that we don't have PD models, we don't have kind of ECL models or LGD models, then I think we should be starting with a different set of conversation than how you are managing your credit risk. What tools are you using? Do you have kind of a loss rate analysis? Do you know what is the historical loss rate on your portfolio? Yes. If you know that how much of the default has happened on your portfolio, can you classify that default rate into different segments of your portfolio? So you know that, okay, on X industry, you have default rate of 5%. On the other segment, you have default rate of 2%. If that is available, then obviously this is a loss rate. This can be your starting point to develop a probability of default. Based on that historical rate, you can then calibrate it with a forward-looking information to convert it into a futuristic loss rate or futuristic PD. So there could be simpler approaches as well, which can be used in the absence of sophisticated models, because the standard is flexible. Now, we sometimes have to start with a simpler approach if there is an absence of a more granular data, because if you can apply the standard with the information that you have and the way you look at your credit risk, that obviously so far it meets the core principles of IFRS 9. So that should be the starting point of applying IFRS 9 as compared to no application. So you should have some measure of estimating your ECL anyways. So if a bank turns up and tell us that we don't know that what is the risk on the credits that we are carrying, so that is quite a big question mark on the way they are managing the credit risk.
Thanks, Dr. Ashik, if I may turn to you, what is your views on?
I would say, like, I fully agree and concur with the previous two speakers. So I would not repeat, because we also have like similar context. So the answer is going to be same. Yeah.
Thanks, Ashik. Surendran, any views on that? We are going into this.
I would just add few points. Our perspective, the Nepalese context is very much similar to the Pakistan. I also thought about to add earlier what Khalid had said. Similarly, either it is regarding to the regulatory backstop measures like LGD 45%. We also have same 45% of LGD if we are not able to calculate the specific portfolio LGD. Similarly, in addition, we also have probability default of 2.5%. Especially this principle base has been somehow going in the line of rule-based guidelines by the central bank. So coming to the interest recognition, definitely there is few challenges regarding the calculation of effective interest rate on net carrying amount for the stage 3 portfolios, which requires that the gross carrying amount shall be deducted by the expected credit loss, and the effective interest rate shall be calculated for the interest revenue recognition. That is the principle of IFRS 9. But the regulatory, the Central Bank of Nepal has issued the guidelines that the stage 3 loans shall be booked only on the basis of receipt. So there is a dual recognition principles, no doubt, but somehow whatever the software or the model has will be developed by these institutions. I believe that will enable the financial institution to recognize the effective interest rate for each stages of loan, either individual or on a portfolio basis. But it's like a ideology, like say if it is already impaired, you should not charge the interest on the loss amount one side, but practically the borrower has availed the credit facility, the gross carrying amount, and the bank should recover the interest rate on the full amount. So the ideology versus the practicality, somehow we need to balance it on our accounting system, and hope, as said by the Khalid, and also second by the Asik, Nepal is also not a exception in this context.
Thank you, Suren.
Thank you, Mohan.
So, anyway, finally, I think we have sort of coming close to our endpoint. I would like to ask each of you your final thoughts on what do you think is the biggest challenge that you're facing in the journey of implementing IFRS 9 in your country. So if I can start with maybe Aslan and then.
Yeah, I think one of the challenge, I think that may be common in the region, because I think we have situations where, you know, the regional economies were suffering on stress economic conditions. So the sovereign ratings of the countries were not, you know, something which will give you a minimal PDs. So the question was that, you know, when you're dealing with sovereign bonds issued by the governments, you know, and you look at the credit rating issued by international rating agencies, and correspondingly the PDs to those ratings. So they typically give you an ECL based on those probability of default. But it was very hard for the governments to accept that on the government issued bonds and in local currency also. So the foreign currency, I think the governments are understanding this fact that, you know, there could be a situation where you have a credit loss provision. But for the local currency, obviously, that was a big debate with whether or not it should be translated into an ECL for the government issued bond. And the way the Pakistan you know, central bank has dealt with it, they have issued kind of an exemption that for local currency bonds there should not be any ECL. And I think that's, to my understanding, that's a similar position with perhaps Sri Lanka and also other regional countries. Now that's something which is based on the government's obviously point of view, that they will be able to meet the local currency liabilities in any case. But that assumption may not be entirely true when you apply strictly IFRS 9. So that's quite a struggle, you know, and at the same time, it's a big judgment that whether or not the government can default on the local currency debt or not. So that was a big struggle that we faced very recently. And going forward, I would say we need to be careful about the governance around IFRS 9, because you know, you may develop the models, you will be able to pull out data as well. but who is making sure that, the assumptions, the usage of data, the models remain consistent from year to year, from period to period, and there is robust control on those models, and so that from a financial reporting integrity point of view, I think this area is not misused by the preparers. So that remains a big regulatory concern as well. I think that remains for us as an auditor community a concern as well. How to basically the audit is one thing, but at the same time, the governance that rests with the banking sector, with the entities, how to ensure that there are SOPs which are being developed, but I think the boards and the audit committees need to be more educated around IFRS 9 application, because I think unless that governance level is applied to the IFRS 9 application, that otherwise can raise to the risk of misreporting in certain cases and use of this avenue for profit kind of manipulation, etc.
Thank you, Hassan. Excellent. Ashik, if I can just probably move on to you, and then.
All right. Thank you. So, one of the chairmen of a regulatory body in Bangladesh, in media, he commented that adoption of IFRS 9 will wipe out 40% of the loan portfolio from the bank. So this statistics or this analysis will tell you why sometimes some of the key stakeholders are not interested in adopting internationally compliant standards. So from the perspective of the depositors, we have to protect them, their interest, and the investors. End of the day, we are concerned about the true and fairness of the portfolio size. What is the real health of the portfolio? That is the key questions. Now, the measurement and recognition guideline that we have currently, is it internationally compliant? Is it giving me a true and fair positions? So that is the key questions. So everybody in principle will agree that, well, IFRS will give us the real or close to the true and fair view of the portfolio's health. But now if we are going to move into that direction, that can impact interest of different stakeholders. So I would say we have to step outside the typical accounting boundary and take a political incremental approach to standard setting. So if we cannot manage all the stakeholders' expectation correctly, and also there is international development partners, they are also keeping a close eye on the portfolios and other indicators. So it's managing the internal stakeholders politically, it's managing the external development partners politically and diplomatically. So unless we can manage that effectively and smartly, IFRS 9 implementation will be delayed. And I believe this applies to all markets, not only just our market. So that is my concluding remark. Thank you very much.
Thank you, Ashik. Surendra, what's your view? Since you all are in the process of implementing this year.
Yeah. It's regarding the recent conversation, one of the CEO asked me whether the implementation of ECL will increase or decrease the current loan loss provision, because you need to answer the board and the shareholders for the distribution of dividend. So the CEOs are more likely with the profitability analysis, they are not concerned about the credit risk management process, because this IFRS 9 is forward-looking information, definitely, and it is the main objective of implementing IFRS 9 is to make a sound credit risk management. So any future deterioration or any worst scenario, the entity will have the early estimates of future contingencies and losses, right? So coming into the challenges, in case of Nepal, we still need to look over the impact assessment. Now, hopefully these commercial banks and other financial institutions will have their impact assessment from the July 2024. And once they get the impact assessment, we will know what actually the outcome will be after the implementation of the first initial recognition. And major challenges for Nepal is the concepts or the perspection of cost and benefit analysis, right? So because the comprehensive model buildings are only possible through the acquisition of sound softwares, or some of the mid-level of financial institutions are looking for the spreadsheet model also. But the major concern about the implementation, effective implementation, lies on the stability of models. Which model we use, we should stick on consistently, and it should be stable. And the major consideration need to be focused on the awareness from those charged with governance. They should understand that the risk management is very much crucial. Also, the profit making is the part of business, but the credit risk management, having get all their internal credit ratings of their borrowers, should be intact with their internal control system. And having a good sound internal control system and credit risk management will definitely provide a sustainable business for them also. Thank you, Mani.
Thank you, Surendra. So I think last but not least, maybe we can hear from Pramod about the challenges that they think they'll be facing.
Thank you, Jaisingji. In fact, in India, if we talk about, as discussed earlier, apart from the insurance and bank, all other entities, those are required, have implemented IFRS 9. But most of them are having the simplified approach, the trade receivables and others. But yes, NBFCs, they have already implemented it. The challenges which they are facing and they would further be facing is, of course, the validation of the models for the ECL. And if I talk about now banks, there are two things. One is not recognizing the income because of the income not being receivable due to suspension of the interest. And the another thing is this provisioning of I would say provisioning or ECL when we say. Now, apart from non-receipt of the interest or delayed payment of the interest, there's certain cases where on the breach of the covenants, the accounts are held to be non-performing, and then the interest suspension are there, like non-renewal of the my credits, my loans, non-submission of the statements over 2-3 quarters. So these are the things which are not related to finance, but breach of that results into the loan being categorized as a substandard or more provisioning required as per the current central bank's guidelines. Now, taking all that data of the previous history and then calculating the model for the ECL would be a huge task out here. That what would be the basis on which the expected credit loss for non-submission of the debtors or stock statements or non-renewal all the loans or another breach of any other covenants. So that has to be factored. Another thing that would be there, like under our income tax, I would say taxation, they give specific deduction for a certain percentage, rule-based percentage as a deduction from the income. Now here that ECL would be totally different. So having that and this here, so all those things have to be aligned. So we are all working on that. We are hoping that all things would be sorted out soon. Even in the insurance, recognizing as per 117, lots of issues are being raised. So we have to work, because ultimately they are considering not only the financial statement but the tax impact also. Like Ashik said that they want to declare a dividend. So Ashik said or Surendra said, I don't remember, but someone said they want to more and how much the dividend they would be able to declare. But here not only dividend, the taxation impact is also being considered by various insurers, I would say, out there. So these challenges have to be addressed to implement IFRS 9 and 117. Thank you.
Thank you, Pum. So actually, from this conversation, there are a few key themes. I think governance is one of the key themes that comes in because of the sophistication, complexity of the models, and the consistent application of these models. So governance seems to be coming through there. The next is the variability in your bottom lines as a result of the ECL as opposed to incurred loss model. And I think the third thing that is the involvement of the regulators. So in most jurisdictions, the central banks have to be on board. They have to give guidance on these things. So these are some of the implementation challenges that really I just summarized in a broad sense what are the key challenges which is across the institution. So last of all, I just a few minutes if Rajit has any comments to make before I close the session. Rajit, are you online or?
Yes, sir. I think I'm good from my side. I think I've covered whichever the areas that I wanted to cover. So I'm good, sir.
Thank you very much to our esteemed panelists for sharing the knowledge and experience in this whole journey of implementing IFRS 9. There are two hands up. I'm not too sure how I'm supposed to deal with this. There is a Said Sabah Hussein and also Shanka Silva. Shanta, do you know how whether they can comment or they have to type in their comment? I thought they had to type in any. Shanta?
Mr. Jaisingh, that we can put that question, the answer to the Q&A option.
Okay. No, most of them are asking about the CPD link. So there is nothing.
Yes, that after at the end of the session, then we will share the link directly to their email address.
So so therefore, with that, I think we will end the panel discussion. And from my side, thank the panelists very much for their insightful discussion which we had, and Rajit for his very in-depth presentation. So with that, I will sort of close this session. Shanta, you can take over.
Thank you, Mr. Jaisingh, and our respected panel members for sharing your knowledge and insightful discussion today. Before concluding, I would like to inform you that the CPD feedback form link will be sent directly to your email address. And to conclude, once again, I would like to thank Mr. Rajit Pereira for his excellent presentation and Mr. Jaisingh for moderating the panel discussion. Indeed, our gratitude to panel members representing the SAFA countries, Bangladesh, India, Pakistan, and Nepal, joining and sharing your experience and knowledge. Finally, I thank you all participants who joined with us today. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you, everyone. Thank you, Monil, for the moderator and excellent presentation from Rajit.
Thank you.
Hoping to see you.
Thanks.
Thank you. Bye. Good evening.